all of those negatives of last year turned around from headwinds into tailwinds.
I think there's still signs of stress under the surface.
We think that earnings are going to go down probably between 7 and 10%.
You've got a good chance of the Fed being on hold for some time, given sticky inflation.
I think it's very difficult to imagine us getting back to 4% on the 10-year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Bank earnings in America just around the corner. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures right now positive 1/3%. Some pretty decent data out of China we can talk about in just a moment. Later this hour, earnings from Bank of America. Then, Tom, after the close a little bit later, we turn to the regionals.
What if they do a JP Morgan? What if we get, like we got China GDP, we get Bank of America and Goldman Sachs, like they're going to survive. They may make it to 2024. John, to me, the headline here off the China news and the JP Morgan follow on into these banks is we're on the cusp of 4,200 on the SPX. Nobody's talking about this. When do the bears capitulate?
We've talked about this for a while. The range, the tightly defined range of the year so far, 3,800 at the low end, there and thereabouts, 4,200 at the high end. And we're about to break through that tightly defined range, just below it right now, looking at equity futures. Tom, you mentioned China GDP. TK came into the studio this morning. It was all he would talk about. China growth, Citi, SocGen, upgrades this morning, 6 handles for GDP in China for 2023.
This is really important. I was showing Qantas, our executive producer's got a nodding acquaintance with China, their chart. And they used to be like an 8% GDP, the glory days. And then starting, John, right off 2007, there's a gradual decline in GDP from 7-ish down to 5-ish. Then you run into the modern noise of COVID and all that. 4.5 isn't 6% GDP, but the vector is phenomenal. It really shows they could get a sequential liftoff on consumer spending in China.
So, Lisa, we've got to talk about a couple of things. The economic fundamentals, China data, one of those things. Then we've got to talk about the earnings. We'll do the traditional bank earnings dance. Goldman, Bank of America, Morgan Stanley tomorrow. Then it's the names we barely ever discuss. All of a sudden, that's a key feature, a key focus of earnings season.
So far, the theme really has been consolidation of power among the biggest. The biggest banks absolutely crushing it, seeing really good profit beats and seeing just a consolidation of deposits. We're seeing not necessarily such a clear story from some of the smaller banks. We've seen that reflected in those bank stocks selling off, even amid some of the positive results that we're getting from the big banks. I will say Bank of America is going to be interesting from the commercial lending, the commercial office space and things of that nature, the mortgage-related assets. Because if they give a tea leaf about that, not necessarily for Bank of America, but the bleed over to some of the smaller banks could be interesting.
You know what I can't wait for? Apple Bank earnings in a few years.
Yeah.
You excited for that? 4% returns on savings over at Apple Bank?
Yep, that's just basically for opening up, and now people are talking about cannibalizing from Marcus. Goldman Sachs and Apple teaming up for this thing.
So when does Washington say, Tim Cook, you're not a bank? I mean, it's a really interesting conundrum.
It's fascinating.
But they're doing it through Goldman Sachs. It's fascinating,
But to Lisa's point, you can get more through Apple, backed by Goldman, than you can through Goldman via Marcus. Can you make sense of that?
Just the incentive to try to open an Apple account. Well, there's just these sort of an incentive for a credit card account. I don't know how this is going to really read through. Maybe Goldman Sachs will talk about it today on the earnings call.
John, I'm a fossil. I'm doing what I was doing 15 years ago. 3-month LIBOR, 5.27% up a tick today.
Yes, some of these names have got to compete with that. They've got to compete. I don't think JP Morgan and Bank of America are some of those names, based on the fact that those deposits have been going to them regardless of what they're offering, Lisa.
And this is basically the issue. Can they offer a haircut when it comes to their certificates of deposit, their other accounts that do offer interest, because people would rather pay a premium to get the safety of the name?
Let's turn to the price action. Equity futures with a lift on the S&P 500, positive 1/3%. A rally here off the back of better data overnight from China. In the bond market, yields come in a basis point on a 10-year, 358.51. I have to tell you, though, the move in a 2-year, worth looking at. We've gone from 350s about a month ago back to 420 in the last 24 hours. Yields this morning retrace some of that move. Lisa, yields this morning down about 3 basis points at the front end. The 2-year, let's call it 417.
It's been a really difficult market to really game out. It has been a tight trading range, although not necessarily in bond yields, which have been all over the place today. We do get those bank earnings around 6:45. We get Bank of America 45 minutes from now, and Goldman Sachs around 7:30 a.m. Eastern. Western Alliance after the bell, people are going to be focused on because those shares are among those got really pummeled over the past 2 months or so as people tried to game out which smaller regional banks were potentially the most vulnerable. 8:30 a.m. we get a slew of housing data, building permits, housing starts, as well as the New York Fed Services business activity for April. I'm looking at housing starts. I want to understand how much they're actually coming back, because at the end of the day, we actually have a deficit of housing in the United States. And so this is being sort of a push-pull for home builders who don't see a great picture for them given where mortgage rates are. But at the same time, if they're buyers, well, you might as well build. 1 p.m. we get Fed Governor Michelle Bowman speaking at a Georgetown University event. This is going to be an ongoing week of Fed speak. I don't know how much it matters at this point, John. I mean, I know people say, and Tom, you've been saying this for a while, it doesn't matter. It's the parlor game, et cetera. But at this point, do they have any more visibility than we do? Or is it just going to be a game of telling the market, hey, we're going to raise rates, stop it already with the cuts, and we're just going to plug forward?
To me, it's a calendar item in that we're where we are, which is the end of the first quarter with a lot of data on that, but we have a complete mystery about Q2. So once again, as they speak, John, they're flying blind.
Oh, without a doubt.
They're flying blind like everybody else.
Time and data, Tom. It will solve that gap
Lisa,
between
sorry to interrupt.
the market and the Federal Reserve. You always interrupt. What you were sorry about?
Oh, I don't know.
This a new you. This a new you.
It's the more sensitive me.
I can tell. Marvin Lowe joins us now, Senior Global Macro Strategist over at State Street. Marvin, great to have you with us, sir. If you don't mind, I'm going to start with a note from Marko Kolanovic over at JP Morgan, who said this yesterday. Even a mild recession would warrant retesting the previous lows and result in 15% plus downside. Went on to say, we view the recent rally as irrational. We continue to believe a recession is likely this year. Marvin, do you believe the recent rally is irrational?
You know what? It has been a very thin rally. There are certain parts of the market that are doing well, others that continue to struggle. So I think that there is some rationality in reallocating into certain sectors that appear a bit better positioned for a recession. Having said that, valuations are still quite rich, and after the whole bank stress earlier this year, for me, recession odds increase and hard recession odds increase along with that. So it does seem irrational from a valuation perspective, but I do see some asset allocation trends that have some sense.
Marvin, from a global strategist standpoint, are we in a bull market? I mean, do you say you look at the U.S. market, and as a general statement, witness China GDP, can you say we hit a bottom, we're in a bull market, and you need to participate?
Yeah, I don't think we could say that yet, and I do think that investors are being attracted to cash. So one of the things that we're seeing are cash levels going up, kind of this money market type of discussion that's going out there, and that certainly shows a hesitancy in terms of committing to this bull rally. So again, it's thin from the perspective of not only the breadth of it, but also investor behavior, which is showing cash as being a viable alternative in this kind of volatility.
Is this churn enough to get bullish, Marvin? And I ask because I was looking at a Michael Hartnett note from Bank of America, the latest fund manager survey showing that investor allocation to bonds is the highest relative to stocks going back to 2009. Is this basically a contradictory or potentially a contrarian indicator signaling perhaps you ought to get a little more bullish?
Well, I mean, that fixed income allocation certainly is fascinating. I do think that there's a lot of ultimately protection being bought with the sovereign part of that market. So, this treasury discussion that we always have and whether or not, we've seen the high yields already within the 10-year is a sign that there's some protection being bought from a duration part of the discussion. So no, I wouldn't read into it that way. Certainly issuance in the corporate space is not as robust as it was last year. It certainly hasn't fallen off, but kind of having said that, it's really the sovereign protection that people are looking at from the fixed income world.
Marvin, what I'm struggling with right now is I see a lot of people who are seeing signs of the all clear on the financial side of things. The stress of the last month starting to fade. See that indicated by data from the Federal Reserve on both Thursday and on Friday, and they're willing to bid up equities because of that. But when you ask them about the bond market and the rate cuts priced in, they're not willing to push back against that. Now, I don't know if you can have both at the same time.
Yeah.
I just wonder, do we have to go back to March 8th if you truly believe that we are going to avoid the banking stress? So allow me to go through the numbers. March 8th, the day before SVB starts blowing up, the day after Chairman Powell opens the door potentially to a 50 basis point hike, the 2 years at 5.08%. The 2-year dropped to 3.55 on March 24th and has since come back to about 4.20 in the last 24 hours. Marvin, where does that 2-year belong if you believe the financial stress of the last month is going to have limited impact on this economy?
Well, I mean, we've seen some data move in the right direction. So it's not as if the world has been unchanged. Certainly some of those ISMs were frightening to a certain degree. But having said that, on the inflation front, on the employment front, you don't have enough clarity to actually say that we're going to get to a soft landing, which is ultimately what I think a lot of these asset values are pricing at this point. I do think you need, if you're willing to write off any bank stress, which includes credit tightening and the impact that credit tightening can have on the economy, you need to see a 2-year get back above 450 easily, and the view that the Fed is not done in May. We're not necessarily in that camp, but if you're going down that route, you can't have your cake and eat it too, ultimately.
Marvin, thank you. At the moment, many people in this market want their rate cuts and their S&P 500 too. Marvin Lowe of State Street. Seems to be the way, doesn't it, at the moment? Before we've even seen the recession, I spoke to Brian Levitt yesterday, guys.
Oh, what did he say? What did he say?
He said that maybe October was the low, and that was the market pricing in the recession. And I said, so we're pricing in the recession in October, and we still haven't had one. And now we're pricing the recovery to the recession that we haven't seen. Well, does that make sense to you?
Some people say we're already in a recession, and it's basically a very soft recession, and we're going to see that basically borne out by the data. I can't make sense of this market. I feel like we're waiting to get confirmation of something, and instead we're just getting a drip feed of data points that don't really give us a clear picture.
I don't agree with that at all. What I noticed out on Twitter, Lisa Abramowicz, follow her on Twitter.
I do.
She has a great chart out there showing the gloom now, not on the edge of 07, 08, 09, but it's there. I mean, it's the first. People aren't in this market. People have the doubt, the Bramo doubt that's out there.
I am one of the many millions that follows Bramo.
Oh, stop.
On Twitter.
VIX under 17, John. It's a 6.6 standard deviation move from the March 23rd panic at 30.
Can I do my tease now?
Please.
Let's go again. This hour, Bank of America earnings.
Yes.
And then in the next hour, we're going to catch up with Apollo Asset Management's Jim Zelter. Looking forward to that conversation a little bit later. Equity futures up 0.33% on the S&P 500. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Sudan's Rapid Support Forces, a paramilitary group that has been fighting against the army for control of the North African nation, has agreed to a 24-hour humanitarian truce. The announcement comes as fighting continues in the capital with some of the most intense violence around the main international airport and army headquarters. The UN's envoy says at least 185 people have been killed. China's economy grew by 4.5% in the first quarter from a year earlier, the fastest pace in a year. A rebound in consumer spending after the end of COVID-0 and a ramping up in government infrastructure investment helped GDP growth come in faster than the 4% forecast by economists. The latest indicators for March, however, show a more mixed picture, with industrial activity remaining subdued. Clients pulled $4.4 billion from Credit Suisse's European and U.S. funds after the UBS takeover. The data from Morningstar only includes funds that report daily numbers and doesn't cover all of Credit Suisse's asset management. The outflows highlight the challenge the firm faces to retain clients after government-backed takeover. And SpaceX is aiming to launch its next-generation Starship rocket on April 20th. It's the second attempt for the groundbreaking flight. SpaceX delayed the planned test launch of its Starship rocket system, blaming a pressurization issue that took place in the minutes before the scheduled liftoff. The uncrewed mission is a critical step in SpaceX's plan to send humans into deep space. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Geopolitics lead to a fragmentation of the global economy into competing blocs. This calls for greater policy cohesion. not compromising independence, but recognizing the interdependence between policies and how each can best achieve their objective if aligned with a strategic goal.
I think that was a clinic for the French leader from Christine Lagarde, the European Central Bank president, on the geopolitical issues dominating the conversation worldwide at the moment. Live from New York City, welcome to the programme. Big couple of hours ahead. Bank of America earnings a little bit later on this hour. In the next hour, you'll get earnings from Goldman. Going into that, equity futures solid, firmer, up positive by 1/3 of 1% on the S&P. We advance. Yields come in a couple of basis points on a 10-year, just sub 360, 357.94. And in the equity market, you see a lift there, but in the FX market, that's where the story's been. The story has been on euro dollar through 110 last week, 110.76. Right now, positive 0.4 of 1% at 109.74, with some fresh data out of China looking pretty good. The economy continuing to rebound. First quarter growth up 4.5% from a year ago. Retail sales also beating with a 10.6% surge. That's the biggest monthly gain since June 2021. There were some soft spots. Industrial output, fixed asset investment rising less than estimated. But across the board here, TK, pretty strong stuff, leading SocGen, Citi, to upgrade their GDP forecast for the year.
Really important here, and we need to get some depth on this right now. Carl Weinberg joins us, Chief Economist and Managing Director, High Frequency Economics. I got 5 things to talk to Carl about and no time to do it because of China. Carl, you're writing a blistering note this morning, and what's fascinating is you say there's a lot of noise in a 4.5% China GDP data. Maybe it's not as good as it is, but you end by saying this is a trajectory to 6% growth. Do you buy that right now, that they can get to 6% GDP growth?
Oh, sure thing, Tom. Good morning. But they could be asleep at the switch, and GDP could not grow at all from even where it was at the end of the fourth quarter, and they'd still get their year-over-year change in GDP at 6% at target. You know, there's a basis effect. Last year was a miserable year, so growing from a low base is not a great accomplishment. Look at that 4.5% GDP number, okay? Pre-COVID, we have never seen a GDP number as low as 4.5% since the data began in 1995. So, you know, let's not be teenagers and talk about relative to expectations or relative to the last 3 quarters, which were awful for China. This is a better than expected number and a better than previous number, sure, but it's an awful number.
But within your acclaimed China note, they're going to do what they've always done, which is clear out the property market, get it back going as an incentive for the public. They're going to straighten out the SOEs in that. What is your forward run rate for China GDP if it's not 7% of long ago and far away?
2 to 3% maybe, Tom.
Really, that low?
China's economy has been driven by investment, and that investment in previous decades has had a huge rate of return on investment. But in recent years, they're using public money not to invest in productive infrastructure, but to invest in real estate. And investing public money in owner-occupied housing is a 0 rate of return for GDP investment. So we're subtracting away all of the fill-up from investment out of GDP growth that we saw in the past, and that's a strategy that leads to subpar economic growth in the very, very low 2 to 3% range.
Is this a reason why, Carl, the reaction in markets has been less than incredibly enthusiastic? We haven't necessarily seen an incredible cry of enthusiasm from Chinese equities and bonds, and we're seeing oil actually lower on the day. Is this the correct read, that anything that China prints, it might have a high number, but longer term, it's going back to a much lower number, and this isn't necessarily a screaming recovery?
Lisa, you hit the nail right on the head. If only GDP would print a high number, we get a positive reaction to it. But 4.5% year-over-year GDP for the first quarter is an abysmal result. The only good thing you can say about it is it's better than some people forecasted, and the only other thing good you can say about it is it's better than the 3 quarters before it. But again, to repeat, this is the worst quarter for GDP growth that we would have seen in the pre-COVID period. We're nowhere back to normal in China.
You also point out, Carl, that trade with Russia by China really was an incredible increase that really got your attention. What's your takeaway from a 136% increase in terms of trade with Russia by China?
Yeah, I nearly fell off my chair when I saw that result, Lisa. That's the real story this morning. If you dig into the trade numbers from last week, China's exports to Russia exploded 136% just in the days after Putin and Xi meet. The only other time we've seen a number for year-over-year growth of exports that big was when Putin came to China for the Olympics 2 years ago, and immediately we saw 140-something% growth of exports year over year. China's selling something to Russia. I don't know what it is, but as you might imagine, it could be problematic materials.
Dr. Weinberg, I was sitting on a stage at the IMF, and I said, I can't wait to talk to Carl Weinberg about the unspeakable at the IMF meetings, which is, will China join Western restructuring methods and processes? You are truly expert on this. Do you have a belief that China can restructure Ghana's debt along with West?
Well, I think China can restructure China's debt. They own most of it. And I think, though, that they don't want to restructure it within the Western framework. And if anything, this is an opportunity for China to channel refinancing through its own institutions rather than through the existing Western institutions to promote their own. So restructured loans to the emerging world should be restructured through new credits out of China's institutions. And that way, China becomes more important geopolitically, more dominant in the world stage than it was before. I think that's what's going on in this restructuring business.
Carl, what does global GDP look like? You know the IMF news of a subpar 5-year view. The optimist Carl Weinberg, I just can't see you going all IMF GDP growth. What do you think of it?
Well, they call it a rocky recovery, but where's the recovery? GDP grows along, at a 3% rate, a little bit lower than normal. That's not much of a recovery. But most important, Tom, your takeaway from the IMF forecast should be that they're flat as a board, straight as a line for 5 years. And that ain't never happened before. If you read Larry Summers' review of the IMF's forecast, he says their forecasting isn't that good. They've never called a recession before. But more importantly, if your economy is not in recession now, and it hasn't been in recession recently, it's got a 20% chance that it's going to have a recession in the next year. And that's what we want to look at, the variance that the IMF doesn't address in its forecast. And there are risks ahead of us. I heard you talking with Marvin Lowe a few minutes ago about risks of U.S. recession. There are risks to growth out there, and we have to keep an eye on those risks more than on the center of the channel, if you will.
That's a really interesting point. A really interesting last point to wrap it up. Carl, thank you, sir. As always, Carl Weinberg there of High Frequency Economics. We've talked a lot about the earnings we're expecting this morning. A little bit later this hour, Bank of America. Next hour, Goldman Sachs. Right now, J&J beating a raise. EPS comes in at 268, the estimate 252. Looking out from here, they offer us a range, EPS 1060 to 1070 for the full year. That is up from 1045 to 1065. Lisa, you're going through the headlines as well. What do you see?
Just across the boards, as pharmaceutical sales come in at $13.4 billion versus the estimate of $12.7 billion. Consumer healthcare sales also beat up about 7.4% year over year. So all of these highly positive at a time, again, when people are expecting pretty low results. I wonder how much we can actually talk about a behemoth like J&J with some very specific issues as being a bellwether, and what companies can we use as a bellwether?
I mean, they got a first quarter litigation expense like John Farrow's $6.9 billion. That's about
where does that come from?
That's a close to your bill.
Nuts, isn't
What
it?
is that? But the one that amazes me, I'll read it exactly because I don't believe it. J&J first quarter COVID-19 vaccine revenue sales $747 million. The estimate was $204 million. So I have no idea what that means, but as Lisa nails, it's just an oddity.
Well, and I will say, as far as the legal bills, I mean, the talcum powder and all of those lawsuits that have been in the news, that's been a big issue as they try to fight some of that. So even with that cloud hanging over, they can still, kind of.
I had no idea they were making COVID-19 vaccine revenue over at J&J still, did you?
I think that a lot of people wrote it off as a non-existent thing. And then I've gotten my booster, still got COVID, but I got my booster.
9.2% return last 10 years. It just doesn't get it done compared to a lot of others.
Stock is up this morning by about 2% in the pre-market. Later on this hour, earnings from Bank of America. Equity futures going into that. Equity futures positive, 1/3%. In many ways, the week begins right now, this hour, with earnings from Bank of America, then on to Goldman a little bit later this morning in the next hour, then on to Morgan Stanley tomorrow. Going into all of that, equity futures positive on the S&P 500, a lift off better than expected GDP data out of China, better retail sales data out of China as well, up by 1/3 on the S&P 500. On the Nasdaq, up 0.6%. In the bond market, just a quiet repricing of the two-year yield. Bear in mind, a couple of weeks ago, 360s on a two-year. Yesterday, 420. Right now, 416. Yields lower by about 3 basis points. On a 10-year, 358. Down by 2 basis points. Lisa Wright to talk about the Fed speak. That picks up a little bit later on today with Governor Bowman, I believe. And then going into the weekend, of course, quiet period begins into the Fed's May meeting. That's come about so quickly. In the FX market, dollar weakness, the story of the last month or so. Euro strength. See some of that this morning. Euro dollar just south of 110. 109.74. Positive 0.4%. Just to guide you through the earnings. Lisa's done this already, but I think it's worth going through once again. Bank of America today, alongside Goldman, Morgan Stanley tomorrow. All the big names we typically talk about. But after the close, after the bell a little bit later on this afternoon, First Horizon, United Community Banks, Western Alliance. There's going to be a big focus, Tom
Western
Keene,
Alliance is a
on
big
the
deal,
regionals,
right?
without a doubt.
That's an outlier because it's like the Western Beverly Hills kind of ethos, right?
Yeah.
Do I have that right? Yeah.
Well, it's a West Coast bank, sure.
No, it's a West Coast bank, but there's different West Coast banks. Zions has been around. I remember Zions has always been a struggle, like for 30, 40 years. There's just certain banks where everybody knows when you hear that name, you're like, okay, what's going on now? And I would suggest Western Alliance is one of those.
But I would say, Tom, I would go further. I think many of these names are names we would just never talk about.
Yeah.
On this program, we just talk about the big players, get a flavour, a taste for what financing to the global economy, the US economy looks like, and move on. And that's not been the story of the last few weeks.
Moving on to SPX, breaking out the new highs here in the recovery, 41.92. I'm on the 4,200 watch as well. This is a joy, and for global Wall Street, and particularly American Wall Street, now's the time to stop and lean forward. David Conrad has not done one but 2 tours of duty at Keefe Bruyette and Woods, definitive on large cap banks. He works for the banking franchise of KBW, a Stifel company. David, thrilled to have you on today. What I know is I got 48,000 people at Goldman Sachs. I got 200,000 people at Bank of America. It's like over 250,000 bodies. I know when there's stress, bodies go out the door. Will there be layoff announcements today?
Probably not today. I mean, we've already seen a few. We think that will continue to be a trend throughout the year. But we are seeing, much better trading than we thought coming into this quarter, which will help. But there are longer term pressures on net interest income that will weigh on returns for the industry.
What does it mean to see Apple Goldman generate a 4.15% savings account? What does that mean for Mr. Solomon?
I think from Goldman has an interesting standpoint where they've never had a funding advantage, right? So they've always borrowed wholesale. So the fact that they're borrowing an expensive savings account is actually accretive for Goldman. The interesting thing, though, is the pressure that it puts on the rest of the industry. The savings account at north of 4% is a staggering premium to what banks are paying right now.
Are we learning anything from the big bank earnings, David? And I say this because we thought this would be the tea leaves we were looking for. And then we get guidance that's kind of like, we're not sure, but we're setting aside more loan losses. We're doing well. We don't want to celebrate too much because it's liability in Washington, D.C. Are we learning anything more substantial from you?
Well, I think yes and no, right? So J.P. Morgan was really a very positive result, and I think is going to be an outlier throughout the earnings season. I think the other names that have reported have been somewhat more in line with expectations, and the key there is declining overall deposits, but more importantly, a negative deposit mix shift. And what I mean by that is checking account non-interest-bearing deposits are down mid to high single digits quarter over quarter, and that's putting pressure on the cost of funds.
So when are we going to know what the verdict is on this earnings season? It's sort of been purgatory for a while, and people are kind of using the data point to fit their narrative. We've been talking a lot about that. When will you be able to say decisively, yes, this shows that there is a real lack of credit availability under the top tier of companies and banks?
Yeah, I mean, I think a couple points here. One, I think Bank of America will be interesting today. Again, we saw J.P. Morgan had relatively lower cost of funds relative to the group. So how much of the benefit from the flight from some of the stressed regional banks is really supporting this quarter. The other thing, though, is we haven't seen any loan growth. The one aspect that we have seen is credit cards. So we have seen growth there, but be careful what you wish for. And so I think, the trend that won't really be showing up this quarter, but going forward, is the increased liquidity requirements we think will really dampen credit growth.
David, you have such a perspective working with Thomas Schode. I think of KBW, I think of Sandler O'Neill, where you guys are doing banking 24/7. Do you just assume a new round of consolidation and combination in the KBW world over the next 3 to 5 years? Is there a new acceleration to go from 4,000 banks down to X thousand?
Yeah, definitely. I think right now, we're kind of jammed up. One, it's tough to get deals approved. And two, the mark-to-market of the balance sheets are really limiting the ability to do mergers. But to your point, 3 to 5 years out, the regulations, the environment's getting more and more difficult. We expect a lot of consolidation.
Let's go all nerd right now. What's the average blended mark-to-market markdown right now? On a par 100, it's trading, it's marked down. Is it a 2-point, 3-point markdown? Or dare I say, is it a 20-point markdown?
I think it's more in the 10% markdown. I think we're really focused on the bond books right now. And really, it's really not really the markdown per se, it's the liquidity associated with that, right? That's what you have to work the two in concert. But we are seeing much better rebound in some of those marks this quarter, probably about 30% better than what I thought in terms of the rebound of the negative marks we saw last quarter.
Just a sign of the times that you get earnings releases, and we've just got BNY Mellon crossing the Bloomberg, and the focus seems to be on one thing: deposits. First quarter total deposits, $281.29 billion. The estimate, $277. So that's a touch better than expected. A bit of commentary from leadership at the bank. BNY Mellon CEO saying, we need to remain vigilant given the heightened uncertainty. Lisa goes on to say we're pushing forward with the strategic agenda.
So the deposits actually came in better than expected, but net loans came in below expectations. And this is what I think really speaks to how banks are managing the bottom line. This might not speak to a big deposit flight, but it is speaking, John, to this restriction in credit extension. And that perhaps could be the leading tea leaf for the market and the economy.
EPS bang in line, Tom. 112, the estimate. 112.
David Conrad with us with KBW. David, if you're still there, I look at BNY Mellon and it's just a moldy 7-8% return over the last 10 years. What's the expectation of total return from a bank? Is that what I'm going to make?
It's interesting. We've said that a lot about the universals since the great financial crisis, right? Are they utilities? All this increased regulation.
Yeah.
I don't really think that's really the case, right? I mean, JP Morgan just put up a high teens ROTCE, with almost 14% capital, right? And so I think it puts more stress on your strategy, on the management team. But what we're really seeing, though, is the bigger banks with the diversified revenues and the scale are delivering, I think, better expectations as we move forward.
What's more interesting to you, David, the deposit growth or lack thereof, or the loan growth or lack therein?
I think the loan growth is more of an economic side. It's probably less impactful for our models, but it does concern us about, GDP growth, for instance, longer term. I think the deposits is really the uncertainty that creates a lot of deltas in our near-term earnings expectations. We've gone through a period of QE and government stimulus and people working from home, and we just have a lot of deposits at the bank that are going to be normalized here. And I think, this normalizing trend, we've been here before, checking account balances are 35% of total deposits. They probably should be 22, 25%. And so that trend has happened before, but what hasn't happened before is that trend reversing while we're having increased liquidity requirements from the regulations. And so, those two things working together, I think, do, to your point, limit the credit extension.
Hey, David, wonderful to hear from you. As always, David Conrad there of KBW weighing in on some of the financials. BNY Mellon just out. Bank of America is going to come out shortly, maybe in the next 10 minutes or so.
No.
Lisa, we haven't had a shocker yet, have we? I know it's early days, but we haven't had a shocker in this earnings season just yet.
Did we have enough time to get a shocker? And this is really going to be one of the questions as we're here in purgatory with people trying to find some sort of aha moment to cling on to. Can we get that aha moment, or do we need more time for the credit tightening and for some of the fissures from Silicon Valley Bank to play through markets?
I don't have the numbers in front of me, but okay, so deposits walk out the door. It's headlines. BNY led with those headlines, and I get it that it goes to a money market fund like at Schwab. Their money market funds were up huge. So deposits normalize, and then I guess it goes from money market funds back to deposits. Is this on some form of long-term quarter-to-quarter basis? Is this really that big a deal if deposits catch up?
It's going to be a bigger deal to certain parts of the financial system.
Yeah, that's the point.
It's certainly going to be a bigger deal for the regional banks, Tom, relative to some of the major players. That's for sure.
I agree that some banks, like M&T is always held up as a trophy bank, but I guess selected bank, it's like Buffett says, the water runs out and you find out how dressed the emperor is.
It's just math. If you have basically a bank that was making incredibly loose loans to a lot of people for low interest rates, they can't do that anymore if they have to pay up for those deposits, if they have to pay up for the cash that they're using. So they have to either hike up the interest that they're going to charge, or they've got to underwrite fewer loans. And that's really what's going on.
I'm watching the loan demand. You asked Conrad about that, and I agree. Where's the loan demand? That to me is the big question out there, and in America at least. I don't know about continental Europe and the rest. Is the loan demand there? I'm not sure it is.
That's the next phase of this. The phase we're in right now is just to focus on the deposit base of some of these lenders, some of these financial institutions. BNY Mellon coming out with first quarter deposits, beating analyst estimates. The stock doing okay in the pre-market, up close to 2%. In the next hour, in about 50 minutes from now, we'll catch up with Apollo Asset Management's Jim Zalter. Really looking forward to that conversation. What was it like the days, the weeks after SVB collapsed? These guys have raised so much money. How easy was it to put some of that money to work, TK?
To measure the distress. Just that simple. You got to measure the distress, and then you got to act, and you got to act when the fear is the greatest. That's what they do.
Jim's out to just around the corner. Coming up shortly, Bank of America earnings.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Video released today by the Kremlin shows Russian President Vladimir Putin meeting officers in Luhansk and Kherson, two occupied regions of Ukraine. It's the second time in a month Putin has toured the newly seized territories. Ukrainian forces are preparing to mount a counteroffensive that Kyiv hopes will provide a decisive breakthrough. Meanwhile, Russia has shelved plans for an offensive of its own after failing to gain much ground. UBS says it will use some shares that it repurchased over the past year to finance the acquisition of Credit Suisse. According to a statement, the Zurich-backed lender bought back about 299 million shares. Switzerland's largest bank says it's using repurchased stock because it didn't want to issue new shares for the $3 billion deal agreed last month in government-brokered rescue talks without consulting shareholders. Bloomberg has learned that BlackRock will begin selling failed bank assets, kicking off with mortgage-backed securities later today. This as the U.S. Federal Deposit Insurance Corporation looks to offload $114 billion of assets picked up from failed lenders, Signature Bank and SVB. And CEO Tim Cook officially opened Apple's first company-owned store in India, betting the iPhone maker's retail outlets will help accelerate sales growth. The company's sales in India hit a new high of almost $6 billion in the year through March, highlighting the market's increasing importance. Apple is exploring ways to reduce its reliance on China as tensions between Washington and Beijing continue to escalate. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Can we stop calling it a banking crisis? This was not a banking crisis.
Tell me why this wasn't a banking crisis.
A banking crisis is a crisis of the banking system. This was a banking tremor. A few banks that were caught offside and badly supervised went down. The big banks are just fine, and we're seeing that. In fact, the big banks are benefiting from this because they've got two things. Not only are they viewed as safe, but they've got diversified business models.
The big banks are benefiting from this. That was Mohamed Al-Arian at the IMF World Bank spring meetings down in Washington, D.C. last week. And Bank of America, well, they look like they're benefiting from this. Shonali Basak, these numbers look good. What do you see?
They're pretty solid here. You have net interest income, which is what you're most concerned about here, coming in line with expectations, just a squeak above expectations. Also a little above expectations, though, are also those net charge-offs. Remember, this is a time where analysts, Wall Street, are watching so closely for how consumer credit is doing. But as we've seen from the banks so far, so long as they're lending a little more, Wall Street is accepting the fact that they're going to lose a little bit of money on loans. It's not that much more than expected. They also blew through the roof on fixed income trading. Let's see how long that boost lasts for across all of these banks. So far, JP Morgan, Citigroup, Bank of America just blowing through the roof. It's a good thing for Bank of America that's trying to invest in that business. Non-interest expenses above expectations. So they're showing you they're investing as they try to gain share in these businesses.
The stock has had a decent run over the last couple of days following numbers from JP Morgan, Citi and Wells. It's up again in the pre-market by a little more than 2%. How do these numbers compare to what we heard from JP Morgan just last week?
I think one thing that's really important is in the commentary, usually Brian Moynihan waits to tell you during the media and analyst calls what they expect for the year in net interest income. And after you saw JP Morgan raise their expectation by billions of dollars, there's pressure on Bank of America to keep up. Now, interestingly also, you have that average deposits declined by 30 billion or 3%. That's an interesting number to keep an eye on because we know that industry-wide deposit flight is at bay. However, a record number of digital logins exceeding $3 billion, or 3 billion logins here, 130,000 new consumer checking accounts. So how many more consumers can they rake in even with that deposit pressure is a pretty interesting
Let's
fact.
go to first order conditions here. The price to book, just apples to apples off the Bloomberg, is just under 1 for Bank of America, and it's 1.55 for JP Morgan. And yet people like us compare and contrast the two banks all the time. What I notice here is you say is Bank of America keeps up or catches up is revenue up 13%. What is the quality of that revenue up 13%?
And even more than the revenue, also that return on tangible common equity here of 17%. It is through the roof compared to the investment banks in a lot of ways, but below JP Morgan. And the difference here, Tom, is not just a consumer, but the type of consumer. You have a huge asset and wealth business at JP Morgan. It's the same reason you see Morgan Stanley.
And Bank of America doesn't have that? I thought they had Merrill.
They do, but they also have a wide base of many, many American households. You have JP Morgan punching stronger on the asset and wealth side than you do Bank of America. That is just a fact. And so if you look at it, Bank of America has actually shown that their average FICO score per consumer has gone up over the last couple of quarters, which I think is an interesting fact. I think when we're thinking about the big banks versus the regionals, who are the customers that they're banking is an important question.
Another way to say this might be that there's sort of a dragnet of all the highest quality borrowers out there by the biggest banks. Absolutely. They're taking them up, and then some of the smaller regional banks are left to extend loans to the less creditworthy borrowers, which puts them in a more vulnerable position. Is that your takeaway right now from earnings that once again surprised to the upside for one of the behemoths as we wait a bit unnervous to hear what we hear from perhaps Western Alliance later?
It certainly is, and think about it. Remember, there's certainly hundreds of thousands of clients that are flocking to Bank of America that are quality clients. They just told you 130,000 new clients that they brought in the quarter. But with that said, when we think about the weakness of the regional banking system and this flock to quality, can these big banks take on how many clients are leaving these other firms behind, especially when you have these firms operating in lending and deposit areas that some of these banks were not in?
I want to hear from Brian Moynihan. He's going to talk about the incredible increase in revenue, the incredible increase in profitability for this bank, and its fortification of its balance sheet. But he also may talk about commercial real estate and their mortgage presence, which is significant. What are you expecting to hear on that front?
Two things. One is that if rates cool, maybe mortgages come back a little bit. Secondly, they're not as exposed to some of the areas that you saw some of the regional banks exposed to. I heard Tom talking about Zions, for example, earlier. What many people don't realize about a firm like Zions is that not only does it have a lot of commercial real estate exposure, it has more of its total loan book than many others tied to commercial real estate, particularly office, which is not necessarily the same for Bank of America, which also, by the way, has a stronger securitization function here, too, to offer. some of the risk.
John, you and I sat on the deck at Davos with Mr. Moynihan, and I remember it was a complete banking nerd fest. We busted his chops by saying we're not going to ask, how is GDP? And we did all the Moynihan. Their PDF presentation, folks, in this is the single best of all the banks, and that's because of the nerd fest that is Brian Moynihan banking. It is a joy to read a 39-page PDF that actually tells you what they're doing. Good.
You mean
and
you
bad.
don't want his view on rates?
I don't want to. I don't care what the Fed.
Is that what
what's
you're
the
saying?
Fed going to do? I don't care. What I like is average loans and leases of blah 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 increased or 7%. Total nerdfest PDF presentation.
Shanali.
Yeah, I mean, I just want to give some more color into the credit losses in particular
Sure.
because they're
Were you
important.
ignoring me there?
We're all
Trying
at
to.
Nerdfest right here. Let's be honest. And so it's credit card balances, partly offset by improved macro outlook. So to your point here, Brian Moynihan, he's been sanguine for a year and a half while everybody's been gloomy. And you definitely see it in the way they're talking about the provisions.
They have a chart of checks written versus Zelle transactions.
Why
That's
are there
precisely
checkbooks
what
anymore?
Can you believe that?
America.
They have
Checkbooks in this country.
radio-
People love them.
It's on radio. I'm sorry. The checks are going down back to 2020, and the Zelle's going up at a bigger slope.
The
There you
digital
go.
logins, Lisa, that Shanali was talking about, I think that indicates the kind of time that we were going through over the last month. Just everyone logging in and checking. Is it still there? Is it still there?
And then also, what else can I get for how much income? I mean, how many
Yep.
people were doing that as well?
Shows you why Goldman and Apple are trying to give you $4.15, right?
Well, can I just point out one other issue? Their total compensation expenses came in above expectations, and this is interesting to me. 1.9 trillion versus, or excuse me, 9.9 trillion versus the estimate of 9.8 billion. Excuse me, 9.9 billion versus the estimate of 9.8 billion, crushing it. I am curious about the competition for talent at a time when people are talking about Wall Street layoffs.
The competition, interestingly, never went away. We did see some kind of boiling back of talent over at Bank of America. But remember how long Brian Moynihan tried to hold on, move bankers around. But guess what? Think about how many massive deals we've had announced this year already. I wouldn't call it a full-scale comeback, but you definitely see activity coming back. And again, these fixed income numbers are nothing to cry about. Remember, this is a business where buy-side competition is stiff. Every major hedge fund in the world thinks that they're bond traders now when they used to trade equities. So, you know, that means competition for talent.
I've got to squeeze this in. Goldman in the next hour. What have we learned over the last couple of days about trading and what we could see over at Goldman?
Listen, the bar is so high now, isn't it? Because you have Bank of America, JP Morgan, Citigroup all beating meaningfully in fixed income trading. And even though there's pressure on trading, you want to see Goldman win in a core business for them. They've been beating equities as well. Remember, there's a few quarters they even beat Morgan Stanley, which is pretty remarkable. But again, the consumer business, after that Apple announcement yesterday, a lot of questions about what David Solomon's ambitions are, especially when they said that they're scaling so much of it back.
Shanali, wonderful coverage as always. The coverage from Shanali Bassett will continue. The stock is higher by 2.8% in the pre-market. Decent couple of days of gains for Bank of America on Friday following numbers from JP Morgan, Wells and Citi. Those gains continued yesterday. And Tom, we look forward to Goldman Sachs in the next hour and on to Morgan Stanley tomorrow.
For those just joining us, there's an overlay here, as Shanali alluded to, and the idea that with Mr. Cook, Cupertino, and Apple, they're going to generate, that's a legitimate deposit rate, right? 4.1%, whatever it is. I mean, that's like the real deal.
Not quite money market fund, Bramo, but decent enough.
That's better than some market money funds. That's actually really good.
I mean, if you run it out triple leverage, it's a gross of 12%. You take out the fees, the 220 payout. It's good. I like it.
I'll take 5, if you can get it still. Can we still get 5 somewhere? I'm sure we can.
I've looked. It's hard to find unless you're investing in some other more speculative assets, which is interesting. You start looking at the prospectuses and you start seeing what else they're investing in, and you wonder whether people's desire for safety exceeds their desire for that 5%.
John, checks written down 29% in 36 months.
Why are we
There's
still
the
writing
analysis.
checks? Why are we still writing checks? What's that about?
I write very few. I got a stack of them.
I know people in Manhattan that pay their rent with checks still.
Yeah.
Which is just bizarre. Why are we still doing that?
America. 4,000 banks. 4,000 banks.
Now
is
you
the way
can
we
do that,
it.
and I can repeat it, but I can't say it.
You can't do that if you don't stop.
Equity
Are we
futures
doing the coronation?
on the
Are we going to
S&P
the coronation?
up 0.4%. We are not going to the coronation. Live from New York City, Goldman Sachs earnings in the next hour.
the banking data massively improves, all of the doom and gloom goes away.
I'm not sure that regional banks themselves finding some stability is enough to really help the market from here.
We already see further tightening due to bank lending standards.
The soft landing is certainly possible. It's not easy to do given where inflation is.
Inflation is high and sticky, and it's not going to get back to target anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
So far, so good this earnings season. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures on the S&P 500 right now, positive 0.4%. Earnings from Wells, earnings from Citi, JP Morgan, and now Bank of America, TK. So far, so good. B of A in the pre-market up by about 2.6%.
Lift to the market up off China. We had a nice lift off 4.5% GDP. Carl Weinberg was great on that. And then a secondary lift here moments ago. We're really buttressed up at 41.95, right up against that 4,200 level. We're never getting there. The market's going to hell. We're never going to see 4,200. What's that? What percent of the street is that?
It's 5 minutes away, potentially. Potentially.
To me, it's like half the street, 60% of the street is really looking for something more tepid.
We've talked about this range between 3,800 and 4,200 all year. And if we break it, Lisa, it looks like we're going to break it potentially to the upside. We're very, very close to doing so this morning. Tom mentioned the data. China GDP, retail sales better than expected. Citi, SocGen now looking for 6 handles on GDP growth in 2023. That's phenomenal stuff. Let's talk about the earnings, though. Trading numbers from Bank of America, pretty decent. Is that a decent read for Goldman in about 25 minutes?
So how much does it take to set up the short squeeze that everybody's been waiting for? To your point, there's been a lot of bearish positioning. And if you look at some of the short positions in the S&P, they're at the highest levels. If you just look at the E-mini futures, they're at the highest levels going back to 2011. The catalysts that we have seen so far are not enough because they don't necessarily say that the economy is all clear. What they are saying is that Wall Street is minting billions of dollars of profits, potentially at the expense of some of the smaller firms.
The revenue lines across Bank of America are pretty impressive. I make jokes about check written in Zelle, but I'm sorry. The actual sales of the quarter were impressive. The short squeeze thing is really important right now. There's different kinds of short squeeze. The traders, John, spend all their time on the hedge funds, this, that, and the other thing. Are they getting squeezed out? Are they panicking? But there's also an American public short squeeze coming out of COVID, coming out of the pandemic. When did they throw in the towel and become optimistic? Certainly, Lisa, with what you tweeted out an hour ago or so, I think it was Bank of America research, they're nowhere near that pending short squeeze.
Goldman Sachs numbers about 20 minutes away. Then on 2 tomorrow, we get numbers from Morgan Stanley. Bramo's going to go through the day ahead, the regionals after the close a little bit later. Western Alliance leading that effort. Big focus on that. Equity futures right now on the S&P 500 shaping up as follows. A lift here up 0.4%. Yields pushing higher in yesterday's session off the back of better than expected Empire manufacturing data. Ton of Fed speak later this week. It kicks off in just a moment. Your 10-year at the moment, Lisa, yields down a basis point. Your 10-year just sub 360 at 358.70.
So what happens if these big banks report billion-dollar earnings and nobody cares? That is what we're finding out right now. Perhaps the shareholders are caring because you are seeing a pop in the shares, but not necessarily a broader reaction in some of the other areas of the equity markets. We got Bank of America earnings now in about, I don't know, a half an hour, probably a little less. Goldman Sachs is coming out. Western Alliance after the bell, as well as First Horizon and a number of other regional banks setting off for the rest of the week to be a really big earnings season. I just don't know whether we have enough information to be conclusive to get that short squeeze that so many people are talking about. 8:30 a.m. we get some details on the housing market, U.S. building permits and U.S. housing starts. How much are people actually beginning to build houses again, because there just is that demand and there is this lack of housing that people keep talking about. At 1 p.m., what you were talking about, John, Fed Governor Michelle Bowman's going to be speaking at Georgetown University. Very curious to hear whether she takes the same tone as Waller at what we heard on Friday, that basically we have a lot more to do. The banking crisis was not a crisis. All full steam ahead with rate hikes.
Governor Waller pretty hawkish going into last weekend, going into this weekend. The quiet period begins. No more Fed speak after this weekend, so they're all rushing to get their final speech in. With us around the table, I'm pleased to say, Dan Greenhouse, Chief Strategist at Solus Alternative Asset Management. Dan, welcome to the show. Good morning.
Thank you, sir.
Are we learning that the bank stress of the last month or so is more idiosyncratic than systemic, or is it still too early?
I don't think there was really, in my opinion, I don't think there was a debate from the beginning that this was not idiosyncratic.
Clearly, there were specific factors to Silicon Valley specifically, but Signature as well, that I never really found were system-wide, so to speak. That's not to say that the unrealized losses throughout the banking system isn't a real thing. It is. We know that it is. But to give you the best stat I could give you, Silicon Valley Bank had 17 branches and somewhere around 150,000 checking accounts. Fifth Third, which is a comparably sized bank, deposit-wise, has 1,100 branches and like 1 million accounts.
It's a different base.
It's a different thing entirely. So we were never particularly concerned about there being a banking crisis, if you will. Certainly there's an issue that has to be dealt with. But I don't know that hearing that said, I don't know that hearing from JP Morgan and Wells Fargo tells me what Western's going to tell me after the close. That's much more consequential.
We're still trying to gauge to what extent we're going to see a tightening of lending standards and how contained macroeconomic spillovers will be. Have you drawn any conclusions on that just yet?
Yeah, listen, the short answer to any question like that is a few basis points off GDP. Everyone. I don't have any particularly new news on this. We know lending standards have been tightening going into this. We assume lending standards will tighten further coming out of it. And we also know that on balance, the level of tightening that we've seen is traditionally associated with worse economic outcomes than better economic outcomes. I don't think that narrative is likely to be changed at all from the large banks telling me on balance that loans are continuing to expand. There's a lag. And ultimately, I think it ends up weighing on GDP by somewhere, call it 0.3 or 0.4 of GDP, something like that.
Dan, you're a strategist to a hedge fund. You live in the billions dream. Do we overweight what we think are the bets of hedge funds? If we're trying to establish a strategy that's longer than 3 hours, if we're trying to establish a 9-month or a 3-year strategy, is there value in measuring the long-short bets of your world?
So we are not active traders, if you will. We've owned positions for 10 years.
I like to say 10 minutes.
No,
Yes.
That's not the world in which we live. I think certainly actively trading hedge funds that flip positions on a daily or weekly basis.
Is there value to that information? Everybody's transfixed by it.
Well, yes, in the sense that momentum strategies are going to be derived from that trading activity and are going to be related to that activity. But we're, as I mentioned, a much more long-term focused investor. When we take a position, oftentimes it's to control the company. We are the second or third largest holder of several companies. Other times we'll get in and out if the thesis changes in let's say, a month. But we are not actively participating in the market. Is there value in those types of strategies? Sure. But I think it's value for a certain specific type of investor, not our client or our investor base, so to speak.
So just pushing against some of the bearishness out there has been the credit markets that you really focus on, has been some of these longer term bets where people are looking more for opportunity than they're worried about losses. And you're seeing that under the hood pretty much across the board. Do you make of that people still do have confidence that this is going to be some sort of shallow recession, that we're going to emerge on the other side with higher rates, that you want to capitalize now?
You know, I know everyone says this is going to be a shallow recession. And I find that statement to be more a function of comfort than analysis. And what I mean by that is it's very easy to say this is going to be a shallow recession because forget career risk. The likelihood that you're wrong and saying, well, it's going to be something more than that is quite high. Now, that said, we also, and I don't want to speak for you guys, I apologize if I'm saying this wrong, but how many times do we follow up and say, well, what do you mean by a soft recession? Well, I think we could define this in terms of basis points moves in the unemployment rate. If you think the unemployment rate's going up by 1%, yeah, that's probably something resembling a shallow recession. But as we all know, there's really no instance in which the unemployment rate goes up by 1% and then stops. It's quite often a much more accelerated move from there.
It feels like we've been in this purgatory for a while, where there's sort of on the one hand, on the other hand, and this lack of any clarity whatsoever. When do you get clarity of what we're heading into?
Yeah, you and everyone else, I think that's obviously the top question of the day. I would have told you at the start of 2022 that by the middle of 2023, we will be in something or close to something resembling a recession. Now, here we are in the middle-ish of 2023, and I don't think we're anywhere close to a recession. I have been in public bearish on risk assets over the course of that time. I more or less remain so now, although there's some caveats to that. But it's remarkable the way that the economy has performed in the face of such rapid increases, which brings up something that you guys were talking about yesterday. I think Tom mentioned the IMF report and the World Economic Outlook and the discussion of the natural rate of interest. Excuse me. And I think there is a lot that we don't know about the current environment, but with respect to the natural rate of interest, I think it's fair to say that whatever we thought the natural rate of interest was, or that the level of interest rates that balances supply and demand throughout the economy, is higher than we previously thought, which means what we thought the economic damage, so to speak, would be from 500 basis points of rate hikes is not quite what we thought it would have been. It might take 600 or 700, I'm rounding,
there you go,
to do the same amount of damage that perhaps a year ago we thought 500 basis
John,
points.
Bloomberg Financial Conditions Index from a -5 standard deviation, we are out to a positive 0.19. That's called not doing what Jay Powell wants.
I'm just tying everything together that you've said in the last 10 minutes or so. March 8th, pre-SVB, 2-year yield north of 5%. Is that where we're going back to, given what you've just told us?
Well, I will say, if you look at the 3-month and the 6-month bill yields, they're both now north of 5%. I was surprised at the level of decline in the 2-year. Let's say that. To the extent that the 2-year is going to be anchored to the federal funds rate-ish, a drop of that's move, and you see this echoed in the Fed fund futures and the Eurodollars futures market. God rest its soul. It's the level of pricing adjustment seemed excessive to me based on my original comment, which was I didn't think that SVB was anything other than idiosyncratic.
Yeah, I got bad news. Doug Cass is listening, and he's got a Yankees question, but we're not going there. Doug Cass looks out and says, "Look, dividend SPX 1.7%." Lisa's talking about 5% money. How does the stock market elevate off of that 5% yield?
Yeah, listen, it's a tremendous headwind right now, and I don't think it's sufficient. First of all, hi, Doug, but it's not sufficient to look back historically and say, well, the market rallied in 1983 and interest rates were much higher, which everyone meaningfully older than me likes to remind me of. I think there are challenges to the equity market right now from the fixed income space. That said, in the credit market, where we spend a good amount of time, the high yield market is still yielding somewhere around 8.5%, which isn't particularly high yield. Even triple Cs, which is the lowest part of the market, which isn't really a market so much as a bunch of idiosyncratic names that get lumped together, is yielding less than 1,000 basis points. If you had anything resembling poor economic expectations priced into markets, they just simply wouldn't be trading there.
Credit spreads wouldn't be at 440 on high yield. We were through 500 basis points for, 5 minutes, Bremo?
I mean, if credit's a leading indicator, it's not indicating much stress. That's the
Not
point.
at all. Hey, Dan, this was smart. It's great to catch up. Thank you, sir. Thank you. Dan Greenhouse there of Solus Alternative Asset Management. Live from New York City this morning. Good morning to you all. Earnings from Goldman, about 15 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The group of 7 nations vowed to support Ukraine for as long as it takes in its fight against Russian forces. G7 diplomats met in Japan again today and condemned Russia's war against Ukraine. The bloc also called for greater engagement with China to stabilize relations with the world's second biggest economy, including a peaceful resolution with Taiwan-related issues. Taiwan will buy as many as 400 land-launched Harpoon missiles intended to repel a potential Chinese invasion. Congress approved the deal in 2020. Taiwan had previously purchased ship-launched versions of the Harpoon, which is made by Boeing. The contract with Boeing was issued on Taiwan's behalf by the U.S. Naval Air Systems Command. The United Nations is making a renewed appeal for international aid for Afghanistan. Afghanistan remains cut off from the global financial system since the Taliban took over in 2021. The UN says $4.6 billion in foreign aid is needed to import food and jumpstart the economy. Without it, per capita income could fall to $306 next year compared to $512 in 2020, making Afghanistan one of the world's poorest countries in the world. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Our national debt is too high, far too high. And the problem is getting worse, not better. American debt is a ticking time bomb that will detonate unless we take serious, responsible action. Unfortunately, I have not heard from the White House since our very first meeting. So here's our plan. In the coming weeks, the House will vote on a bill to lift the debt ceiling into the next year.
Well, there's the plan, there's the goal, so to speak. The House Speaker, Kevin McCarthy, addressing the New York Stock Exchange in the last 24 hours. Unclear whether his own party is on board with his plan. We can talk about that in just a moment. Goldman Sachs earnings out in about 9 minutes' time. When that drops, we'll catch up with Shnali Basak, who, of course, is on top of these numbers for us. Bank of America numbers better than expected, off the back of better than expected numbers from JP Morgan, Citi and Wells. Looking out for Morgan Stanley tomorrow. The big players are doing pretty well. Equity futures right now on the S&P 500 up 0.4%, a lift in the equity market. The smallest of rallies in the Treasury market. Yields down a single basis point. Tom on a 10-year, 358.70.
358.70, John, and you and I are watching the equity market. I mean, we're nudging towards 4,200, and you heard what Dan Greenhouse just said. I'm sorry, to me, it's like a pretty important day if we get a breakout on some of this stuff. We're not there yet.
BofA up 2.3%. I think what Dan Greenhouse is getting is back to the conversation we were having in early March before the banking mess, basically suggesting that he does not see a recession on the horizon right now, and ultimately, Lisa, making the argument that maybe this Fed needs to do even more to slow down growth. Now, that was the conversation of a month ago, and that disappeared pretty quickly.
He said that potentially rates have to go to 600 or 700 basis points, 6 or 7%, to achieve what 5% would have achieved in the minds of many before. This is what we were talking about going back before March 8th. Why is the market not coming to that same conclusion? Because people are basically viewing us as going back to low rates and low inflation.
I was going through the numbers yesterday evening on the Bloomberg terminal, just going to the March 8th number. March 8th is basically the day before SVB blew up. It was a Wednesday. It was the second day of testimony from Chairman Powell. The day after, he opened the door to potentially a 50 basis point hike at the Federal Reserve. The 2-year that day was close to 5.1%. Tom, in the weeks after that, the 2-year dropped to about 355. And now we've come back up to 420. And I think that back-up move is something worth paying attention to. It's off the back of several indicators, a couple of which suggest that maybe we've seen some stability in the banking system. So the question from the last month is still the same question. To what extent is the stress of the last month a substitute for rate hikes? But
exactly. That's where I would go.
Clearly people starting to lean in the other direction again over the last couple of weeks.
I think it's really well said and frames it out nicely here. And it's to watch rates. You can do that off the BTMM screen on the Bloomberg terminal. I guess it's about the debt ceiling, but I guess I'm going to go all Butch Cassidy on you and say, who is that guy? Anne-Marie Horton joins us now, Bloomberg Washington correspondent. I look at Kevin McCarthy, and as a complete amateur, Anne-Marie, I'm saying, is this guy getting the traction of Boehner? Is this guy getting the traction of Ryan? He's out of Bakersfield, California. He was a firefighter years ago, but basically from when he came out of, I believe it was Cal State, he's been in politics with Bill Thomas from day one. Do we know who this guy is, and how's he doing on this big event, and how's he doing with his Republicans?
Well, he clearly wanted to make the debt ceiling a major issue and outline how the Republicans view it. And what he's trying to do is basically put the blame at Biden's feet, saying it is the president who is refusing to negotiate with me. He said yesterday, speaking at the New York Stock Exchange, bringing his fight right to Wall Street, saying that he hasn't sat down with the president in 75 days. And then he announced that the Republicans will have their plan, because what the White House says is that we're willing to negotiate about fiscal spending. But that is a separate discussion, and you have to keep the debt ceiling discussion and raise it in a clean way. And also, the Republicans have yet to present a budget. So what they're going to do is try to get a bill through Congress. This would put the debt ceiling fight into next year, so raise it for a year, and then also it would come with some spending cuts.
Yeah, Emery, we call it kicking the can down the road, in case that's a new concept. That's a new concept for you. My issue here is when I hear his comments, they're so individualistic. They're not me, but they don't speak to an institutional Republican belief, a foundational Republican belief. Does that belief exist?
Well, this is going to be part of his problem. He has to get 218 Republicans to vote for this. Not a single Democrat is obviously going to vote for this in the House. And also, no one expects this bill to go anywhere. Absolutely dead on arrival. But what he has to be able to communicate effectively to the White House and to America is that he is able to get this bill through. So then he has a little bit of some negotiating power with the White House, because right now what the White House is saying, and Mario Parker put it very well yesterday. You've really seen this administration go after the Republicans using their own leaders' words. They're quoting former President Trump in memos saying, I can't imagine anyone ever thinking of using the debt ceiling as a negotiating web. So they're using past Republican presidents' words against Speaker McCarthy. So he has to be able to articulate that he has the backing of the GOP in the House.
Anne-Marie, this feels like a story on repeat because we deal with this pretty much every year with a debt ceiling debacle or debate. This year perhaps seeming more fraught. When do we have to start caring more? When do we find out just how much time we have until we potentially run out of cash?
So the Treasury is talking about June 5th. That's when they would like to see action move. But for the actual real hard and fast X date, no one really knows. And actually, I believe today is the day you have to get all your tax money in with the IRS. That can actually effectively change the X date. So from June, anywhere from early summer, say June, to into the early fall, that's where this X date will lie. And the issue Congress has is they're here for 2 weeks and then they're on recess again.
So what is the calculus, Anne-Marie, of pushing it to just a couple months before the election?
Well, so it would push it into a couple months before the election. But remember, again, Treasury can use extraordinary measures. So it would only be after the election where they'd have to really start to concern about the X date. But if they do push it into next year, then the debt ceiling, fiscal spending, this becomes a Republican talking point for the election, especially at a time when they want to talk about things like the debt ceiling because they keep getting questions about other topics that don't poll well for independents, like abortion or guns. So this would be one way they can make sure they're constantly talking about the economy next year when obviously it's a massive election.
AMH, great to catch up, as always. Looking ahead to the X date for the debt ceiling debate. Tax returns. Tom, you paid the IRS in the last couple of days? Good man.
Yeah, I sent him a love note.
Donated some money.
Yeah, I did, and I wrote a check. It was the one check.
Is that right?
I write every.
Of course you did. You can use a debit card.
Internal Revenue Service.
You can use a debit card
They
to
have a
make
direct
payments.
pay thing, actually.
They do.
They've gotten very digital. They can take our money at light speed.
Yeah, they can take your money in all sorts of ways.
You know, and this goes back, John. This goes back. We were talking about this off the break, folks. I wish we did Big Little on the break so you could hear us on the break, see how much we hate each other. I look, John, at the deviousness of our tax system. In the old days, think Nelson Rockefeller, you paid a marginal 70% rate. Maybe it was like Britain, whatever. Here now, there's this tax, the Fed, the state. In our case, folks, good morning, Mayor Adams, the New York City tax, FICA, Medicare. There's probably something on there they're not even telling me, and page 40. Add them all up, and you're back out to a Nelson Rockefeller margin.
You need a postgraduate degree just to do a tax return in this country. It's
what's it like in England? Seriously,
not as obscene. Not everyone has to do a tax return for one. If you earn up to a certain amount of money and you are paid and that tax is withheld at source, you don't have to file.
Wow.
I don't understand why in this country, regardless of what you earn, you need to guess what you owe the IRS, even though the IRS knows what you probably owe them. That doesn't make sense to me. It just doesn't make sense to me at all.
Driven over 1 year. But a posh person like you in the United Kingdom,
posh.
How thick is your 1040?
Did this accent give it away?
Carry on.
How thick is your 1040 in the United Kingdom?
Well, I never did one, I don't think so, Tom.
You never did one?
No, because I didn't earn enough money to need to do one. And the money was withheld at source. And
Mr. Solomon, you should see Mr. Solomon's tax return. Here we are. We got the earnings
Giving
out.
away what I used to earn, aren't I? In the equity market right now, positive 0.4%. Goldman Sachs numbers crossing a wire just moments ago. Here's Shanali.
Yeah, listen, John, we have net revenue here that is missing analyst estimates here. It is not a very clean read here because there are some extraordinary items in the sense that they are selling a part of their Marcus loan book, which means the revenue from that business is declining. However, they did beat on earnings per share. We are also watching the fixed income revenue come in below expectations. That is something. Fixed income sales and trading at $3.9 billion. The estimate was more than $4 billion. Remember, when we watched the numbers come in from Bank of America, Citigroup, and JP Morgan, we did see that number come in above expectations. Remember that FIC number at Goldman Sachs core business here. Why has it come in below when the others are winning? Could be just business mix here, but it is a question. The loss that they are reporting on the partial sale of the Marcus loans is $470 million, according to Goldman Sachs as well. Remember, as they they position this consumer bank, there are a lot of questions. They had said they would try to find solutions for this markets loan portfolio. Questions on the call, you can expect them to answer how much more there is to sell and how quickly they would sell off that loan portfolio. The benefit that comes from selling that loan portfolio is a reduction in reserves, which means that where other banks are taking much larger provisions for loan losses, you are seeing that number now be a net benefit to Goldman Sachs as well. And so that, again, this is watching Goldman Sachs change right in front of your eyes as they try to boost away from that consumer bank further into that asset and wealth manager under a new leadership structure over there at Goldman Sachs.
Shonali, thank you. It's not a shocker, but it's a disappointment. The stock is down by about 1.4%. Some of the other big banks, Bramo, came out with some pretty tremendous trading numbers, better than expected. Goldman does not follow suit on certain indicators.
To me, that really is the takeaway, that they missed on fixed income trading after massive beats at Bank of America and Citigroup. They are supposed to be the trading house. They were supposed to win on this, particularly given that Morgan Stanley pulled back so dramatically a number of years ago, and they did not. The fact that they didn't really raises questions about the bread and butter business that made them Goldman Sachs.
Goldman, Tom, a little bit softer in the pre-market.
Yeah, and they're Tony Frada sends out this beautiful note. He's one of my favorite people. It's great. It's not as clear as Bank of America, period. I got consumer platforms at 490 million. You're going to divide that by a number up at the top of the sheet. And it's amazing how people are focusing on this consumer bank experience, and it's such a teensy-weensy part of their business. But the fact is, that's all everybody's talking about.
It is kind of funny that now with Apple you can get more interest from banking with them, Lisa, than you can with Goldman, even though Goldman back the Apple product. That doesn't really make sense, does it? Doesn't Marcus have to lift that up now?
Well, that's the question. Does Marcus have to lift it up, or do they kind of want to shrink it naturally and divert it to perhaps something that's more lucrative? I can't think of any other logic behind this, because this was immediately what people went to. 3.9% on a Marcus savings account, and you get 4.1% on this newfangled Apple Goldman Sachs kind of partnership.
The consumer headache is 4% of their revenue. F-O-U-R. I mean, it's a joke.
It's a roundabout, right?
Yet that's what everybody's focusing on.
Let's reset and talk about this market. Goldman right now down by about 1.4%. For the broader story in financial markets, equity futures doing okay, up 0.4%, a lift again this morning. On the Nasdaq up by 6 or 0.7%. In the bond market, I think this conversation at the front end of the curve gets a little bit more interesting. The 2-year, March 8th, north of 5%. SVB gets into trouble. The 2-year drops into the 350s over the next couple of weeks. And now we bounce back to about 420 in the last 24 hours. I wonder if that changes the conversation in the FX market as well. Let's finish on euro dollar. Friday, new intraday high for the year, 110.76. Right now, 109.70. We're positive on that currency pair by 0.4%. But certainly, Tom, as we fade the immediate instability of the last month and start to get some indications in the last week that we're seeing more stability, this conversation is slowly returning back towards focusing on robust American economic data and this idea that maybe the Fed needs to go further. I think it's still tremendously early days, but that's where the conversation is slowly shifting again.
That's economics dovetailed into the finance as well. We get a huge response when he's done. Can you see an Apollo credit card? I mean, can you see Apollo getting into
that would be cool, wouldn't it?
Banking.
I'm not sure that's what they want to do.
Absolutely not. My hunch is. But we could ask someone
Jim
who knows
Zelter
better.
with us, who's just starting to walk out of the room, co-president of Apollo Credit Card Management. He joins us now with decades of experience in fixed income. John, why don't you bring in a gentleman with an overview of this crisis or non-crisis that we're in right now?
The co-president at Apollo Asset Management joins us right now. Jim, good morning.
Good morning, all.
Great to catch up. I want to start here. Can we just start with the days after SVB collapses? You've raised all this capital. This is like your moment to make things happen. How difficult was it to deploy it?
Well, I think you had to differentiate between a deposit crisis over the first few days, that Thursday and over the weekend when the government took its action, and then you really were talking to a lot of borrowers and a lot of institutions that needed, help. So that week we did a very large transaction and helped out PacWest. But I think what you're really talking about this morning here is a deposit crisis evolving into a business model question. And that's really where the overall evolution of the markets are. But certainly, you know, we've been very busy. We've been very busy on all sides of our business, and there's no doubt that this withdrawal of capital, it's not a credit crunch. It's not an ebullient market, but there's a transition with a higher cost of capital in debt financing across all the markets.
Let's dig deeper into that. Can you describe the spaces right now where you expect traditional banks to retrench from,
Sure.
to move away, to move back from, and where you think there's opportunities for you to step in even more?
Sure. You know, as we've had this conversation about private credit over the last several years, last decade, it's really been, for the headlines, focused on sponsor finance, which is non-investment grade. The real opportunity is the regional bank model really evolves and their cost of financing is up quite a bit higher. There's a variety of asset-based strategies, whether it's in the commercial mortgage space, whether it's in the resi mortgage space, whether it's in solar finance, whether it's in aircraft finance, where the regional banks or traditional banking models, those were interesting businesses. The business that we bought out of Credit Suisse, the Atlas Finance business, which is really an ABS warehouse businesses. Those businesses, typically the underlying risk is investment grade. And for the most part, because of either Solvency II in Europe or other rules, those are just become much more capital intensive and capital consuming for the banks. And so there's a variety of those asset classes that I mentioned. That's like 40 trillion versus a 10 trillion private credit opportunity in the U.S.
But Jim, what I didn't hear you mention was just a pure unsecured revolving loan of credit,
Sure.
which is basically what a lot of these smaller and regional banks delivered to smaller companies.
Yep.
Is that a no-go area at this point?
No, I think, listen, those are smaller, idiosyncratic corporate loans, and someone needs to fill the gap in that. And the reality is the cost of financing has gone up 200 to 400 basis points in the last month. So those companies are getting that financing. You've not seen it yet in the earnings, but certainly that's where we believe this whole idea of tighter financial conditions, it's that exact company that you're talking about that's probably having a more challenging period of time right now securing that financing.
How does that change the equation for you when you decide what size company you want to invest in? The bigger, more stable, better access to financing, going to have perhaps an even better profile versus an even worse one for some of the smaller ones?
Sure. Typically at Apollo, if the capital's coming from our balance sheet, we're usually talking to companies and having EBITDA more than $50 million. That being said, we have a portfolio of 16 portfolio finance companies, of which the CS business, now called Atlas, is one of them. And they'll range in the companies that they finance, that's 3,000 employees, about 80 billion of assets. Those companies will lend to companies anywhere from 10 to 15 million in revenue, so much smaller, much deeper and broader.
But are they as attractive?
Well, what you've seen really across the board, let's just talk about commercial real estate. A lot of conversations about that. Commercial real estate finance, for the most part, like a single A CMBS piece of paper, that was $350 when I came on here 6 months ago. That's $675 today. It's just math. Spreads have widened from 175 to 350 over.
Yeah, I noticed in Washington today, Brookfield giving back 2 properties they can't make a go of. Well, I mean, the commercial real estate thing is tangible. I want to look at the level of the D word, distress, that's out there right now. And I look at it just in a basic accounting standard. How blind are people like you right now off FASB 157, and you can't mark to market debt that's out there now? What's the opacity that's out there in the system?
Well, I think, Tom, if you look at the overall leveraged finance market, it's a couple $1 trillion market. You got to assume defaults next year are probably going up to the mid-high 4s to 5%.
Right.
So that's about $100 billion of challenge credit, if you would, in the forward calendar. If you look at commercial real estate, you got $1.25 trillion that needs to get financed in the next 12 to 18 months. So there's no doubt that there's a portion of that but you're not seeing broad distress yet. You're in the transition period. We had 14 years of low interest rates, and the real impact on valuations, it takes a while to filter through. You're seeing some evidence in the secondary markets, in the PE secondary market. Those names are trading between the high 70s and low 80s. Credit secondaries are in the high 80s, low 90s. VC secondaries in the 50s. So you're seeing it in some markets, but this idea of tighter financial conditions, this takes 3, 6, 12 months to really evolve. And as you talk later on today, you have your big banks reporting today. It will be very interesting to see, on the regional banks, they went from a deposit crisis to a question of their economic business model. How do they make money long term? And, the other side of that is we feel that our business model has only gotten enhanced. We have long-term liabilities. And now those 10-year liabilities in our business, it allows us to be a robust, stable lender in a period right now of flux and conversation.
The heart of the math to me, and the Brookfield article from Bloomberg today is just definitive. At the very bottom of it, in the last paragraph, year over year, the monthly payments on a blended piece of sub-properties went from 330 gazillion out to 880. And the translation of this to me, for all of our listeners and viewers, is in the new math, somebody's got to put up cash to do the restructure. This is a whole new world for a lot of people, Jim.
It's called cost of cap. For a decade plus, and I mentioned it to you all before, equity was the great beneficiary of low-cost debt that really subsidized the equity returns.
Exactly.
Now we've had a complete paradigm shift, and it's just math. You said it earlier. The funding costs, when you hear that there's a credit card out there you're making 4% on right now, or excuse me, not a credit card, but a bank deposit program, that's just a cost of goods sold. And it's a higher cost for somebody. The consumer's the great beneficiary. But back to our model, we are looked at. The American economy. We've gone through a really tough quarter, but 4% of the population, 50% of the financial assets in the world. We have the envy financial markets of the world, and we're evolving right now in a period of 3 to 9 months, but with a higher cost of capital. That's just flooding through the system.
You're in a great spot. That's what you're describing. Is that because of the way the cycle's evolving, or is it more structural in nature? Because it sounds a little bit more like the latter than the former.
It's secular. It's secular. If you take the last, as we've talked before, if you take the last 25, 30 years and the evolving role of financial services around the globe, really led in the U.S., but following on in Europe and a little bit in Asia as well, there's no doubt that folks that are able to operate with the ability that we are to really bring the proper liabilities to the equation. Our investors are sovereigns, institutions, pension funds from around the globe. They're the ones that can make the 5 and 10-year commitments, along with retirement savers. Those are the folks that should be making these loans. I mean, the digital world has really changed the banking market, and there's a lot of folks that are a lot more knowledgeable about the traditional banking system. But again, we just have a lot more tools in our toolbox. We're able to provide a lot more capital. As I mentioned, the PacWest solution, that happened basically in 3 days, $1.4 billion facility for them that really got them through a pretty tough liquidity situation. But it was a high-quality assets that were looked through investment grade. And if you do that, having those solutions, your doorbell is going to ring quite a bit these days.
How much cash do you have in anticipation of the doorbell ringing?
I think our latest numbers as of last quarter are probably in excess of $50 billion of dry powder.
Oh, so they could buy Chelsea.
Well, I'll leave it to you. I'll leave it to you guys to talk about that. But there's no doubt that investors from around the globe. I was in Asia last week, and the idea of really exporting yield around the globe. They've had very low rates for a decade plus. Obviously, a lot of conversations about what's going on in Japan right now with YCC yield curve control and how do they transition off that. I think that's a really interesting story for the latter half of the year. But the reality is we're in an evolving market in the States. What was a deposit liquidity crisis is now an evolution of their business model, and really it's going to be a period of tougher financial conditions.
Let's finish on this.
Yeah.
You describe a process. You're expecting tougher financial conditions. I just want to build on the question Lisa asked. I hate to ask the when question. When do you expect that doorbell just to be non-stop ringing? Because that's what it sounds like you're looking for.
I think by the time that actually happens, all the activities occurred. I think it's almost too late, Jonathan. I think you really need to be in the markets every single day. The reality is, there were some headlines last week that private credit took a step back because of one financing. The reality is the M&A market's a little bit quieter right now, and, LP firms want to do
Jim,
things.
I got to make some news this morning. I'm looking for a Western Alliance transaction. Would you like to break that news here this morning?
I'll let others talk about that one. I got my hands full.
Jim, this was fun. Thanks
Always
for coming
a
in,
good time.
sir. Thank you. Thank you very much. Jim's out there of Apollo Asset Management. Lisa, on some of the shifts we're seeing play out right before our eyes in financial markets at the moment.
And this is what we're hearing from a lot of the behemoths, the private credit, the private equity firms out there that are saying, look, we can take on some of that business that some of these regionals aren't necessarily providing anymore. It just at A, what cost, and B, how much does it leave behind that might not be able to get financing anymore?
I have not done a voluminous survey here, but can I suggest the good news of JP Morgan and other banks versus what we're seeing in Goldman Sachs? I believe never is the operative word. I've never seen it.
Well, look at the spread between what JP Morgan delivered on Friday. Stock up by what, 6, 7, 8%? Stock down at Goldman, down by 3.4%. Session lows in the pre-market. Vishy Tirupattur of Morgan Stanley coming up shortly. Live from New York City. More earnings still to come. Morgan Stanley tomorrow. The regionals after the closing bell a little bit later. Equity futures on the S&P up 0.4%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The United Nations says fighters in Sudan's capital targeted buildings occupied by diplomats and international humanitarian agency staff. Armed personnel entered the homes of people working for the UN and international non-governmental organizations in downtown areas of the capital. That's according to an internal UN document seen by Bloomberg. The gunmen sexually assaulted women and looted people's belongings, including cars and personal items. Forces loyal to the head of the army and the paramilitary rapid support forces have clashed for the past 4 days, leaving more than 180 people dead. China's economy grew by 4.5% in the first quarter from a year earlier, the fastest pace in a year. A rebound in consumer spending after the end of COVID zero and a ramping up in government infrastructure investment helped GDP growth come in faster than the 4% forecast by economists. Latest indicators for March, however, show a more mixed picture, with industrial activity remaining subdued. Clients pulled $4.4 billion from Credit Suisse's European and U.S. funds after the UBS takeover. The data from Morningstar only includes funds that report daily numbers and doesn't cover all of Credit Suisse's asset management. The outflows highlight the challenge the firm faces to retain clients after the government-backed takeover. And SpaceX is aiming to launch its next-generation Starship rocket on April 20th. It's the second attempt for the groundbreaking flight. Now, SpaceX delayed the planned test launch of its Starship rocket system, blaming a pressurization issue that took place in the minutes before the scheduled takeoff. The uncrewed mission is a critical step in SpaceX's plan to send humans into deep space. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
I think somewhere between here and 3 3/4 is a good entry level. If someone says 365, then really you want to go in at 364. I think it's very difficult to imagine us getting back to 4%.
Fantastic to hear from Steve Major, looking for that move lower in yields once again. Steve Major of HSBC, the global head of fixed income research. Let's show you what the 10-year looks right now. Steve Major pushing back against the idea that we can get back to 4% on a 10-year. The 10-year at the moment, 357.18. Yields lower by 2 or 3 basis points. In the equity market, futures still positive by 0.4%. Beneath the surface, though, here's a split. Goldman, B of A. Goldman in the pre-market down by 3.5%. Bank of America up by 1.5%. I have to say, to summarise as follows. Bank of America very much in line with what we saw from the likes of Wells, Citi and JP Morgan. Goldman, anything but. Bank of America this morning came out and absolutely crushed some of the trading revenue figures.
Right.
Lisa, some disappointment on the fixed side of things over at Goldman.
Falling 17%. This was supposed to be the bread and butter. And I think that this is what we keep talking about. How much of a distraction was the consumer banking side of things and the other businesses that Goldman Sachs tried to get into if they cannot deliver on what they are known for, which is fixed income and stock trading, more particularly at fixed income, but also M&A.
Really important, John. I went back and I looked at the moment where J.P. Morgan announced their earnings, and I compared it to Goldman Sachs from that same point in time. Since that good news on J.P. Morgan, the stock is up about 8.4% over the recent days. Goldman Sachs over those recent days, not from now, but over those recent days, is down 1.4%. So I'm going to say that's a 900 basis point delta between J.P. Morgan and Goldman Sachs. Again, I've never seen it.
So the trading miss is one piece of this, but also over at JP Morgan, that raise to the outlook for net interest income
and
for JP Morgan was a pretty unique moment that really helped drive those gains on Friday.
And to be fair, it's not apples to apples. I really take issue with people that conflate all these banks. They're very different beasts. But just from a sheer performance standpoint, you've got to look at the Goldman Sachs board and say, where are we going 3 years from now? Where are we going 3 quarters from now? Would be the debate this morning.
Well, clearly, as you've pointed out, Marcus is a rounding error, right? Seems to be a bit of a distraction at the moment. I think for a long time, Tom, I know you've said this pretty explicitly, or at least you've implied it many, many times. You're just waiting for that headline to drop where they exit the business, aren't you?
Yeah, I have to be careful here. There's a way to exit a business and save face. It's a ballet among courageous people. It involves a lot of employees. These are painful things. But you just wonder what you're doing with 12.22 billion. Is that right, Lisa? And it's 0.4 of that.
Not the only bank under pressure. Let's be clear about that. HSBC under pressure from one of its top shareholders to consolidate the business over in Asia.
Does Goldman Sachs want to be associated with
split it up?
Does Goldman Sachs want to be associated and compared to the Hong Kong and Shanghai?
No, I don't think so. I'm just saying there are still a lot of financial institutions out there at the moment who are under pressure, Lisa, to become something else.
So what I've been doing over here is looking at the market cap of Morgan Stanley versus Goldman Sachs. This used to be a popular parlor game. And right now, Morgan Stanley's market capitalization is $149.3 billion. Goldman Sachs, $118 billion. That delta is just widening out as we talk about who won this game.
And I think we've got the banner here, price to book there. And this is the real apples to apples, John. It's not J.P. Morgan or Bank of America, but Morgan Stanley with a substantial premium price. It's a J.P. Morgan-like price to book for Fortress Gorman versus the challenges at Goldman Sachs right now.
Morgan Stanley's turn tomorrow, Tom.
Yeah, well, it's going to be a turn tomorrow. We're going to get to that with Vishy here in a moment. He's not going to comment on earnings, but well, maybe we'll comment on earnings. But I'm sorry, you're going to get a real wealth management snapshot tomorrow from Morgan Stanley.
Do you want to ask Vishy about Morgan Stanley numbers tomorrow?
Right now, let's get to Vishy Tirupati, if he's still there, Chief Fixed Income Strategist at Morgan Stanley. And of course, folks, the economists and strategists do not comment on the goes-about of the companies. Vishy, right now on the strategy, we have heard guests, Parlor, a 10-year yield to 3%, or dare I say beneath 3%, and others with fear in their voice, price down, yield up. On a sum basis, 12 months out, where's Morgan Stanley?
We are closer to 3%. End of the year number for 10-year treasuries is 3.15% is our base case forecast. So I think we are closer to lower from where we are. And I think 4% is going to be a huge stretch. So lower from where we are.
That said, you can see that the data keeps coming in persistently strong enough to keep things on track. It seems like the banking crisis was not a crisis, at least in the way that people were worried about. At what point do you start talking about reverting back, as John was talking about earlier, to pre-March 8th, to this idea that perhaps this economy has enough heat in it to sustain higher yields for longer?
I think a few things to keep in mind there, Lisa. I think even though we have not had any new bank failures in the last few weeks, the fact remains that the banking system as a whole, the dependence on the Fed facilities, the discount window, the BTFP, the Bank Term Funding Program, is still pretty high. It's around 140 billion of borrowing is happening, and that to us it suggests that there is still a lot of residual tension are related to liquidity within the banking system. So that does not indicate to us that the banking challenges that we're facing are behind us. Also keep in mind that the effect on tightening of financial conditions, that is in addition to all the monetary policy tightening that we've had. Tightening of financial conditions that comes from a more restricted trade supply I think that is yet to be played out. And we will not be so confident that the challenges from the March in the banking sector are behind us.
Are all of these credit tensions being reflected in public U.S. credit markets?
They're reflected differently. I would say they are reflected in the sectors that are most directly affected. Commercial real estate sector most directly in the front and center because of the exposure that the regional banks have. And the crux of the credit challenge is with the smaller regional banks. It's not with the big banks. And the smaller regional banks have disproportionate exposure to the commercial real estate debt that is outstanding and coming due, a lot today, a lot this year, and relentlessly for the next few years to come.
Vishy, to combine your world with Ellen Zettner's world, does yield and inflation, this is Fisherian 101, does yield and inflation follow nominal GDP? And if we see dampened nominal GDP over the next 1, 2, 3 years, do you just assume a lower rate regime?
I think as the economy slows, we should expect to see inflation coming down. That is our base case forecast, and we expect to see that gradually come through. I think as we go through the rest of the year, the expectations for future rate cuts start to get priced in. That's our rationale for lower 10-year number as the economy slows. Expectations of future yield cuts, rate cuts come in, and that brings the level of for example, the 10-year Treasury lower.
Vishy, I've got about 60 seconds. Can I just finish on this? Is there any scenario which you could envision with a decent probability of occurring whereby we go back to March 8th, pre-SVB, and the 2 years back through 5%? Is there anything in your mind that could take us back there?
Not really. I mean, I think it's very difficult to imagine that we've had a major significant turmoil in the banking sector that came with a substantial intervention on the part of the authorities, and that will have to come with regulatory changes, and all of that simply does not take us back to where we were before March 8th.
Vishy, thank you, sir. Vishy Tripatur there of Morgan Stanley on fixed income. This March 8th number, I think, is interesting, Lisa. North of 5%, Chairman Powell talking about 50 basis points. If you believe that this is isolated, ring-fenced in the financial system, that there's limited macroeconomic spillover from here, that lending standards won't tighten too much, then why wouldn't we go back to the last conversation?
I couldn't agree more. And I think that that's what you're hearing from some people. Others, like Vishy, saying that there's a lot of credit tightening that is on top of what the Fed has already done, resulting from the recent turmoil that we just haven't seen yet. And that's sort of the purgatory that we're in. I keep thinking of that because it's what it kind of feels like right now.
Still super early days. We've got the regionals after the close reporting a little bit later. Tom, we'll get a flavour of what that looks like for the smaller and medium-sized lenders through the next week or so. And Lisa's talked about this date repeatedly in early May. The Senior Loan Officer Opinion Survey that we get is going to be still very, very keenly watched in the next few weeks. Stress is one thing, and I think you can gauge stress based on the numbers from the Fed last week. But lending standards, Tom, that's going to be something that's still a feature of the conversation.
Well, I think I could say in years and years and years, what to follow in the banking reports is as more important as it's ever been. I mean, that's where we are. It's just things have changed.
On the equity market and on bank earnings, Sam Stovall of CFRA coming up shortly.
The banking data massively improves. All of the doom and gloom goes away.
I'm not sure that regional banks themselves finding some stability is enough to really help the market from here.
We already see further tightening due to bank lending standards.
Soft landing is certainly possible. It's not easy to do given where inflation is.
Inflation is high and sticky, and it's not going to get back to target anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Bloomberg Surveillance. We welcome all of you on radio, television. Jonathan Ferro, Lisa Abramowicz, Tom Keene, Sam Stovall coming up. And John, we were talking off of it, how you sit every Saturday morning and you look through Barron's to get a feel of what's going on in this stock bull market, 41.92 here. And my question is, which bankers are on the cover of Barron's coming up this Saturday? Do you put the winners up there, Diamond Moynihan, or does Mr. Solomon do a solo turn?
Yeah, let's summarize things as follows. So the big banks, tremendous, led by JP Morgan, Wells Fargo, Citi, Bank of America, better than good. And then Goldman, underperforming here. On a specific side of the trading business, that stock is down by 3.3% in the pre-market. Tomorrow, it's on to Morgan Stanley. After the close, though, and I think that's what's different about this earnings season, typically on the front cover of a financial news publication would be a major bank and a major CEO. Yeah. At the moment, Tom, it's about the regionals. Some of the names typically we wouldn't talk about in earnings season. That's the focal point for this earnings season this time around.
And they're partitioned into banks like M&T the other day and other names I don't know, the Gerard Cassidy world, if you will, that are well-run banks moving forward. And then you've got how many? A select few that we're focusing on? Is it seriously a handful? Is it 25? Is it 142? I don't know.
I don't think any of us really know, Tom, with any real clarity at the moment, and we need more clarity. There are obvious names. First Republic on Monday. Big focus, facing real existential risk over the last month, in a really delicate position. So we'll get some clarity on that name in a week or so. But Lisa, I think the broader story for a lot of people outside of the financials, they want to understand how much lending standards, credit standards are going to tighten in the coming weeks, months, and maybe even the coming 12 months. And I think it's not just market participants that want the answer to that. It's the Federal Reserve as well. Fed officials want the answer to that because they need to work out how they need to calibrate rates over the next couple of quarters.
The problem is, and I feel a bit like a broken record, but as Jim Zelter was saying, it's going to take 3, 6, 12 months for this to bleed through the system. So how do you game that out at a time when we're not going to see it necessarily in the data? What we are seeing, though, is perhaps fewer loans getting underwritten than people previously thought. We saw it with that at Bank of America. Not necessarily some sort of massive sign, but definitely telling of where we are.
I think on a microeconomic basis, this is really important. You're taking the other side of the debate. The financial media is all focused on deposits and asset flows and that. And you're on, hey, how's business? And the answer is we really don't know. And with the Vishyatirapatur, this is important. This debate, folks, of does the economy come down as real GDP comes down along with disinflation? That's a raging debate forward, Jim.
I've just heard the nature of the debate just shift just a touch in the last week, back towards that conversation about US resiliency. And that's not my view. You can just see that backed up by the fact you've seen two-year yields back up again to 420. And the journey of the last month, and I keep framing it this way, March 8th, the day before SVB blows up, two-year yield through 5%, then dropping all the way back to the 350s, and Lisa, more recently, back towards 420. And you can just see how the probabilities are shifting somewhat in the other direction again.
People are pricing out quite as many rate cuts as they were a couple of weeks ago. What you're seeing in the short end, the very short end, 3-month T-bill yields are now the highest, back to the highest that they've been since 2007 at 5.06%. So this, to me, is the stress point.
Right.
Are we seeing sort of the tipping point at which there could be some surprises, some blow-ups, and does the Fed lean into that or try to ameliorate that?
Let's get the data check done. We got a Sam Stovall like under 17 on the VIX, 16.88. I look, John, it's a 6 standard deviation move on the VIX off the gloom, that 30 level, the 27 level, whatever, in March. So it's a huge move forward in the VIX.
Repriced it in a big way. Equities up 0.4% on the S&P 500 at the close yesterday, 41.51 on the S&P 500. The S&P 500, as you all know, tight trading range, 3,800 to 4,200 over the last several months. Tom, a feeling that maybe we break out to the upside based on recent information.
For all the fancy people, the fancy quants, the math, the CFAs, and all that chit-chat, it is about emotion. It's about buying straw hats in winter. Long ago and far away, a guy named Stovall said, you know what? Falling out of a basement window isn't too painful. Joining us, Sam Stovall, as we look back to the emotion captured by the Stovall family over many decades. Sam, are we in a bull market? Did we fall out of the basement window in October?
Good morning, Tom. Well, I do think that the low was set in October of last year. We'll have to see whether it gets challenged or even possibly eclipsed. But I think there is so much negative emotion in the market right now that really the only surprise it would be to the upside. We have 8 of the 11 sectors expected to post declines in this first quarter of 2023, a majority of them posting double-digit declines. And as you said, with so much negativity out there, the only surprise would be the other way.
I have real trouble, Sam, with the modern zeitgeist of short squeezes being hyper-technical in that. My answer is there's many behavioral short squeezes along the continuum. Have we, in any indication, had a short squeeze from the broader public that says, I don't own enough equities?
Well, I think there's an awful lot of cash on the sidelines that's waiting to be put to work. The commitment of traders does indicate that there's an awful lot of pessimism out there. So get some numbers that, if we break above that 4,200 level, where we're very close, and meaningfully break above it and stay above it, I think that's going to trigger a lot of short covering. And that could give us certainly a nice move in the near term. I do worry a little bit about valuations at this point. We're trading at about a 12% premium PE on forward basis compared with the last 20 some odd years. But I do think that the May through October period will be volatile, but will still be positive.
I want to talk about cash on the sidelines. That used to be almost pejorative. People who just didn't want to get any money for their money. They didn't want to actually be part of the market. Now it is actually being part of the market. They're getting 4 or 5%, even in some cases, on that cash. What will incentivize them to go into the equity market at a time when there is so much concern about what's coming, given that cash on the sidelines isn't just copping out anymore?
Good morning, Lisa. Well, I think certainly it's a matter of FOMO. If we do end up seeing the equity markets move higher because of the short squeeze that Tom was just talking about, we do see the markets move against a majority of the sentiment, then I think investors are going to say there's better growth opportunity in equities than sort of staying the course in fixed income. And also, as Jonathan had said earlier, with the volatility of the yields, with the Fed likely to end its rate tightening program by the middle of this year, then I think investors are going to be looking toward equities once again.
And is this going to be with tech necessarily leading if there is still this rate cut bet baked into markets?
Well, if you go back to 1990, which is as far back as S&P has sector-level data, and you look at the 9-month period after the last rate hike, because the Fed typically starts to cut rates 9 months later, the market itself was up 13% on average, and technology was one of the outperformers.
Sam, what's your star dynamic right now on REITs? You and I, over the decades, even when we were kids, the REITs would blow up every number of X years. How do you know when to buy the REITs when they go from a Stovall 1-star to a 5-star?
Well, certainly the REITs have done quite poorly. Right, they are actually up 1% on a year-to-date basis, so at least keeping their head above water. But that compares with a more than 8% gain for the S&P 500. I think that our feeling is we're starting to nibble at some of these groups. We currently have a market weighting on the REIT category, and believe that there are some out there like Prologis and others that are worth owning at this point.
Hey, Sam, wonderful to hear from you, sir. Sam Stovall there of CFRA Research on this equity market following bank earnings, with some select names in the mix as well. Bank of America has just concluded its first quarter earnings call with the media. Some headlines on that call, just around a consumer, I think worth pointing out. The CFO saying the bank is seeing less demand for mortgages. I think that unsurprising for many of you. The pressure to raise rates, Lisa, in a competitive market. He's seeing pressure to raise rates in a competitive market. And this line was interesting. Consumers spending more while balances remain high, and ultimately not seeing cracks in the consumer portfolio. That the latest from the CFO at B of A.
And we've continued to see that also from Citigroup and some of their surveys, that the consumer is still strong, which goes to Dan Greenhouse's point of solace, that maybe this economy, which has surprised again and again with its resilience, has more steam behind it and necessarily is going to end up with a higher rate just simply because of the amount of cash in the market right now.
Bank of America positive by 2% in the pre-market. I think the question for a lot of you following that one, Lisa, is ultimately, Tom, will the regionals say the same thing? Can they say the same thing about how they read what's going on with the consumer relative to how some of these big players view the consumer in America?
I don't want to push it too much, but to me, it's far more idiosyncratic and bank to bank. There's a difference. The super regionals have a lot of big bank characteristics, but beneath, I think I'm going to say 16, beneath that are the regionals, and it's a completely different issue. Stock to stock.
And to build on that, Sonali was talking about how big banks have increased the FICO scores, have increased the credit worthiness of their consumers and of their corporations. So who is left with the less credit-worthy ones, right? So does that sort of change in terms of the haves and the have-nots of the consumer base?
Do you track your credit score?
Not anymore, no.
No,
but
you used to.
Exactly, not anymore.
I mean, I just.
I do monthly.
No, you don't.
I do monthly, yeah.
Seriously?
Yeah, monthly.
Do they have all that silliness in the UK?
What, credit scores?
Yeah.
Yeah.
It's not like an Uber score.
But
it's not like, people are
But
gonna
getting credit in America is tremendously difficult when you first move over here.
Yeah,
when I came, it's
Oh,
really,
yeah.
really
Yeah, I
hard
can imagine.
to get credit here.
So do you sort of evaluate what could have been the driver lower
Yeah,
of
they
your
tell
credit
you.
score?
Yeah, they tell you. They give you some information as to what happened. Yeah.
And then you get angry?
I don't get angry. I fix it.
All right, good to know. Well,
And
I
improve,
don't.
Bramo. You don't get angry. You don't drown in resentment with these things. You look to improve.
Really? You've never drowned in resentment with certain Uber scores?
Never. What are you talking about?
You're so sensitive.
Bramo showed me her Uber score once and I was depressed. I'm at like 494, 495 and Lisa comes in, 499. I mean, come on. 499.
Mine's like 3.
Yeah, well, that's because I got into a car with Tom in DC.
Oh, no.
4 a.m. in the morning, right? And I can work out your Uber score straight off the bat. Gets in, goes straight to the front seat, doesn't speak to the driver, pulls the seat forward and says, "These cars." gets in the back, slams the door as hard as he possibly can. I'm like, yeah. That's a 320 right there. That's a 320. Equity futures on the S&P positive 0.4%. Live from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, video released today by the Kremlin, it shows Russian President Vladimir Putin meeting officers in Luhansk and Kherson. Both are occupied regions of Ukraine. Now, it's the second time in a month Putin has toured the newly seized territories. Ukrainian forces are preparing to mount a counteroffensive that Kyiv hopes will provide a decisive breakthrough. Meanwhile, Russia has shelved plans for an offensive of its own after failing to gain much ground. Bloomberg has learned that BlackRock will begin selling failed bank assets, kicking off with mortgage-backed securities later today. This as U.S. Federal Deposit Insurance Corporation looks to offload $114 billion of assets picked up from failed lenders, Signature Bank and SVB. CEO Tim Cook officially opened Apple's first company-owned store in India, betting the iPhone maker's retail outlets will help accelerate sales growth. The company's sales in India hit a new high of almost $6 billion in the year through March, highlighting the market's increasing importance. Apple is exploring ways to reduce its reliance on China as tensions between Washington and Beijing continue to escalate. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
Really what's happening is that the bond market is saying we have to be much more vigilant about where their earnings are going to go down and where they're going to go up. So companies that have moats around them, different technology companies and other, industries where you can see both margin growth and revenue growth should be rewarded.
That's the latest from David Bailyn, the Global Wealth CIO and Global Head of Investments over at Citi, joining us just yesterday. The latest in the equity market, a lift for equity futures, the S&P 500 at 0.4%, a split in bank earnings, a clear split. Goldman looking a little lonely on the trading side of things. The stock is down by about 3.3% in the pre-market. We'll keep one eye on that and one eye on this. Bank of America, Tom, up 1.8%, largely in line with what we saw from some of the banks elsewhere. Decent couple of days of gains for B of A coming into this number, and the number looking pretty decent.
Is it a split or is it a loneliness? It's going to be really interesting to see how the sell side adapts to what they hear from Mr. Solomon on the conference call.
Let's see what we get from Morgan Stanley tomorrow, Tom, and that wraps up the big players. Then it's on to the regionals a little bit later after the close and through the rest of this week.
You mentioned
into next
today
week.
We see some regionals.
We get some regionals,
Yeah.
I think, led by Western Alliance after the close a little bit later. And then if you want First Republic was actually due to report last week.
Right.
I think on Thursday originally, Lisa, and that's been pushed back to Monday the 24th.
Yeah, and so a lot of people are going to be looking at how idiosyncratic these are and how representative they are. They are just looking at this one story in Wall Street Journal this morning about how a study showing that few banks are really hedging interest rate risk. And about a quarter of publicly traded banks last year, even when rates were rising, actually reduced their hedges. So at what point does that really crimp their potential lending
It goes back to what we saw with
prowess?
Brookfield. I mean, the Bloomberg article today to me is Brookfield giving back, I believe it's 2 properties in and outside Washington, D.C. And the bottom paragraph, John, is some form of year-to-year interest calculation going from 300-some gazillion out to 880 gazillion. This is what Jim Zellner was talking about. Every single company has more cash in. When we say financial conditions will tighten, that's just BS talk for you got to put up more money.
It's balance sheet talk.
You got to put up more money. BS. Balance sheet talk. Thank you.
It's balance sheet talk. If we're doing favourite stories, Isabel Lee of Bloomberg. Did you see ChatGPT reading Fed
No,
speak?
I missed this. I
Did you
don't-
see that?
It was fantastic
It can
study.
accurately read Fed speak and then tell you whether it's good or bad for the market. And can it do it single name on a single name basis as well?
Yes.
Single stocks.
There have been a number of stories showing that it actually is better than probably.
a couple of studies.
You want an anecdote here
Amazing.
before we get to
better
Brian
than
Weiser?
journalists? Is that what you're saying?
I'm just saying, probably we can just have a little chat GPT sitting here.
I'm
with
on
some
the
lipstick on.
phone with my brother, who's a fancy computer guy, and this is what came out of his mouth. There was a point where when you did code and you had to go to books to look at what the next step was, big, thick books, intimidating books, and one day they were all lined up on the code. You could see which choice to make. He said ChatGPT is as big a move as that. He says it's seismically changing the computer business. Seismically changing. I mean, huge deal as well. Let's get to Brian Weiser right now. This on the media. Brian Weiser, Madison and Wall principal. I'm not going to ask about ChatGPT on streaming. It's just when does it merge? I mean, what's so important here, John, is Brian, is the basic idea. When does everybody just decide there's got to be fewer players? How close are we?
Oh, I don't know. I think that's an inevitable outcome, especially if we're talking about the television world. I think the concentration that'll follow from, basically, I think eventually a Warner Discovery does become part of some bigger company. I think the AMCs of the world probably become part of some bigger company. So I think there's more concentration to be had.
Is Netflix at the top of the pile right now? It seems like they struggled and then all of a sudden they have content that's winning. They seem to be a winner. Are they the one that will acquire?
I think that they will be in a good position to do so. They've always been, well, for a little while, they've been cash flow positive, and I think that they're only going to continue to grow on that front. I think their importance is only going to grow. They're going to be able to continue to grow revenue because they continue to invest in content at a scale that is almost unmatched. Here's a fun fact. In the U.S., there's about $140 billion of spending on total video, by my estimates. There's only about $30 billion being spent on streaming services. There's a lot of money to be pulled out of the pay TV ecosystem to go into streaming. So Netflix still has a lot of room to run.
Brian, Netflix is going to be a fascinating story as they report earnings after the bell today, because they used to be the poster child of borrowing money at relatively low costs to pay for that content that built up who they are. That is no longer accessible. Does this give them a more dominant or a more potentially problematic position heading into whatever's next, simply because they've already acquired the content and perhaps the barrier to entry is that much higher?
Well, I think you have more conservatism on a player like Warner Discovery, where they probably shouldn't be so conservative. To the extent that they scale back their investment, that just creates opportunity for others. I think the discipline, as we might call it, that we're seeing across Hollywood is really mostly only applicable to most of Hollywood and not necessarily to Apple and Amazon, at least when it comes to spending on video services. So I think that there's the competition may also not be as intense as it was in 2020 and 2021.
How much do you think they are going to actually start cracking down on sharing passwords? I'm just suggesting that some people do share passwords with either relatives or Friends, and that's one huge stream of revenue that they might be losing.
Oh, it's a big thing. Yeah, no, it's absolutely been a big thing, and of course they were encouraging the sharing for so many years. No, I think the early evidence suggests that there's a lot of new subs to be gained from it. The question is how many, and I don't pretend to have a good answer on that, but it definitely can be a source of incremental growth for them. And the ad-supported tier, of course, is meant to help sustain that too.
Brian, there's lots of gossip in the industry. You read the trade magazines, Variety and all that. You've been brilliant on the ability of TV and sports to sustain. We had bankruptcies around regional sports broadcasts. There's this, that, and the other thing. Is there a mood to put more capital into video entertainment, or is it broken?
Yeah. Well, I mean, this is the thing. I think a lot of people are missing. The only appetite for any investment into content is in the streaming services. There just isn't any appetite to invest meaningfully more or noticeably more money into the traditional linear ecosystem. Sure, sports will continue to benefit. Sports will continue to grow in terms of how much is getting spent on for the linear services, but that will come at the cost of not having as much non-sports content. Total growth in content spending, which is really the driver of the industry, is probably going to continue at a low single-digit rate going forward. But again, the skew is going to be completely towards the streaming services.
So, Brian, basically, we're just going to have live sports and news on one thing and then entertainment as a paid streaming service. Is that basically what it's become?
That is absolutely the direction of travel. And the bigger issue is that so much of the streaming content won't be ad-supported, right? And that's a really critical thing, and one of the main reasons why I spend so much time understanding it. What does this do to the ecosystem that's been so dependent on advertising when you just can't reach everyone on television like you used to? It won't be possible with every passing year.
So, Brian, where do you think that money goes?
From an advertiser perspective,
yeah.
I mean, this is the thing. I think every advertiser will have a different solution. Some advertisers will redefine television to include YouTube and TikTok. Those who do don't have so much of a problem. Right now, they don't define YouTube or TikTok, as long as it's operating in the US, as television. The second solution is to look for other marketing channels. And that means spending more money on things that, it's just idiosyncratic. It depends on the individual marketer's goals. But it won't be as uniform as it used to be.
Brian, are you suggesting Bloomberg surveillance should be on TikTok?
You did have a version of Bloomberg called TikTok once upon a time, didn't you? Yeah, absolutely.
Are you picking up from that?
I'm going to pick up from there. Go away, Brian.
Brian, thank you. Brian Weezer there of Madison and Wall. Consulting on the media industry.
It's wide open. I mean, this guy, Brian.
Is
folks,
Brian allowed back? Is he allowed back?
He's allowed back. He's allowed back. He's going to be here next week, I think. Brian is acclaimed and famous for all sorts of things in this media frenzy we've been living for 15 years. And one of them was his persistency to stay in Facebook. More than anyone, he got right the long Facebook call from the horrific IPO that they did. But, he's a savant about it. But at the same time, he's really grounded in follow the money.
This is where it's been going for a while. Live sport and news, and then everything else. They've been throwing money at content for the best part of a decade. Clearly, they're going to have to be a lot more disciplined than they used to. The discipline's got to extend to a whole bunch of things. Did you see Lululemon yesterday? Do you remember they bought that mirror thing?
Yeah.
How much was
I saw
that?
I don't remember how much that was. No, they sold that. They sold it after buying it earlier. Yeah, because they got rid of it because
what a mess.
It wasn't as lucrative.
Back in the day, zero rates, you could throw money at a wall and see what sticks. Buy a mirror.
And stick it on your wall.
Coming up, the Open, Jim Kerr, Morgan Stanley Investment Management, Lafayette College's Krishna Mamani, Stephen Bigger from Argus, Sarah Hunt of Alpine. Thanks for that, Tom. Thanks a lot.
Meanwhile, back at the ranch, we're looking at 7% mortgages, maybe just a little bit below that, and it folds into a wall of housing data today. Lisa Abramowicz and Tom Keene here, Bloomberg Surveillance on radio, on television, and we're going to get here, we get the New York Fed services business activity. Maybe that's tertiary, but housing data is not tertiary. It's important to all of you. Michael McKee has our complete and total report. Mike?
Complete and total. It looks like we come in a little bit better than expected, but certainly worse than last month. In March, housing starts down 0.8% to a 1,420,000 annual rate. The building permits number falls 8.8%. That is worse than anticipated to a 1,413,000 number. Prior months, 9.8% for starts and 13.8%, well, 15.8% revised for building permits. So a step back in the construction industry. The one thing that's hard to know is, of course, on a month-to-month basis, these numbers are very lumpy, whether this is going to be a trend or not, because the numbers were so strong in February. Housing completions were up, were down 0.6%. That's kind of one to watch because that's what they've got in train. And once that stops or starts to fall, do we see them back off?
Lisa's been working on a family room and a kitchen for 6 months, so the completion isn't there yet. How does it fold into GDP? Are these numbers like PR numbers by the building industry, or do they actually fold into those numbers we focus on?
They've helped fold into both business spending and residential investment. So yes, they fold into GDP, but it's not as direct line as some of the other things that we do.
Yeah,
but it is a certainly measure of the influence of the Federal Reserve with mortgage rates high. We have seen a decline in construction workers last month, so that may just fit nicely with the data we're getting now.
We're also looking at building permits dropping more than expected, which is interesting given what's forward-looking. And, you know, Tom talked about New York Fed Services business activity being tertiary. However, what we saw from the Empire Manufacturing yesterday was much stronger than expected, which is an early read on what's going on there. This coming in negative, less negative than the month before. But is that important?
Negative 9.8. I don't know. Tom, what comes after tertiary?
Tertiary.
Fortiary? Yeah. Well, okay, because this is a fortiary index.
But the Empire Index the other day you really liked.
Well, it was a big move. It is a small sample set. Both of these are small sample sets. And so you can't really extrapolate a lot for the whole nation out of them, but it does show the influence perhaps of the Fed in tightening on service industries, which is something they want to see.
Michael McKee, one of our Fed speakers today, look for him. Lisa?
Well, meanwhile, we're also looking at what it means if there is a softening in the U.S. economy, what that means with the reaction function of the Fed from all these speakers. Kathy Bostancic of Nationwide saying that, yes, there is going to be potentially a moderate recession in the second half of this year. But she wrote, quote, inflation at the core level will not allow the Fed to pause in May or cut rates as it typically does in recession. We look for another 25 basis point rate hike in May and for a long pause by the Fed until 2024 when materially slower inflation allows them to cut rates gradually. This is not being priced into the market, Tom. What you are seeing in the market still are rate cuts through the remainder of this year.
Kathy Bostancic joins us now from Nationwide, really definitive on parsing GDP out and what it means for the nation. Kathy, the stock market is going up. Is that an indicator to you?
Good morning, Tom and Lisa. Well, it is a part of the leading economic indicators. So if you think about the Conference Board's overall index, it's one of the subcomponents. However, that one seems to stand out from other leading economic indicators. It's been as resilient or maybe more resilient than even the labor market. So we have to see really how the earnings announcements and guidance play out to see if the equity market continues to kind of hold in there. As you alluded to, the bond market's been pricing in recession for a long time now.
What's the framework of the consumer right now? I mean, Nationwide's got a huge handle on this. Frame the consumer mood like now and into the next 30 days. Is it buoyant? Is it lethargic? What's the consumer mood that you perceive?
So what we've seen is consumers still feel the weight of high inflation, even though the headline number's been slowing a bit, as we know that the core, particularly the core services number, has been very sticky. And I think the fact that interest rates remain very high also weighs on consumer sentiment. I think that the key, though, is the labor market. And if you look at the Conference Board's measure where I used to work, 3 of the 5 questions are focused on the labor market, where the Michigan Sentiment Index is influenced more by the equity market and I would say even gasoline prices. So you have both you get a different look at the consumer from both of those surveys. I would say overall the consumer's feeling very conservative at this point. A lot of the pent-up savings they had have been expended. They've been able to splurge a bit on the service spend side of things, but now have to kind of recalibrate, especially if we're right and that cracks start to develop in the labor market.
Kathy, there are a number of things that you said that are actually quite controversial, starting with this idea that inflation's going to be too sticky, that's going to allow the Fed to hold rates where they are. The market completely disagrees and thinks that the Fed's going to go back down near 4% by the end of this year with rate cuts. How do you fight back, or how do you argue against people who say, if you look at the disinflationary forces, they're actually stronger than the headline numbers may account for, including U.S. rents posting their first drop since March 2020?
Yeah, and the rent prices that inflation should decelerate at some point pretty meaningfully, as captured by the CPI and PCE price indices. Real-time rent increases have slowed quite a bit. Home prices overall have actually in many parts of the country fallen. So those both suggest that the rental inflation will slow. But even when you exclude that, as Chairman Powell has suggested, you look at that super core service number, it's very sticky. And things like transportation services and, for instance, car repairs are still running double digits year on year inflation. And insurance premiums, we know from what we do, continue to rise as well to capture the higher car repair costs. And it's even broader than that service prices overall still remain sticky. And I think you really need to see the labor market slow before we start to see that correction, because with car repair, it's not that you can't get the parts, is that the labor is still so expensive.
So if this is the case, and you do have stickier inflation, you have a Fed holding rates around 5% for a long time, what kind of shallow recession is this going to be? What are the contours of that?
Yeah, so and that worth just noting that typically the Federal Reserve slow in raising rates and fast in cutting rates when we go into recession. So we're seeing really the opposite dynamic in this business cycle. But the contours is that the consumer balance sheet overall is in good shape. Business balance sheet overall is in good shape. There are pockets of issues, just like in the financial market and the banking system, there's pockets of stress, but overall in better shape. And we think that keeping the Fed funds rate elevated for some period of time should allow inflation to gradually slow, and you avoid a really hard landing in that sense. And that's assuming, though, that inflation does continue to gradually slow.
Kathy, one final question: Do you have a run rate of American GDP, real GDP, of over 2%, or do you have to model it below?
Yeah, so first quarter does look like it's running around 2%, could even a bit above 2%. But as we go into the second quarter, looks slower to us. The retail sales data indicate the consumer spending is the momentum slowing going into the second quarter. Mm-hmm. And these housing numbers this morning, building permits, a leading indicator. I think people are getting joyful that housing may be on an upswing, but keep in mind that interest rates matter, supply matters, but employment and income is really the key indicator for the ability for people to buy homes.
Kathleen Butz-Johnsack, we have joy that you're with us, with Nationwide, their chief economist, this morning. Lisa and I watching the gyrations here at 8:39, I guess off of housing data. We'll get more housing data. But, generally looking at a pre-market chart, frankly, Lisa, I can take it back to maybe 1 a.m. this morning, looking at the futures chart. It's a series of higher lows all the way up. I mean, obviously, there's some back and forth, but I'm sorry, there's a bid to this market. It must be, you did your taxes and Bramo's got a bid to the market, pushing things up here.
Well, I will say that in Asian trading hours, it was basically flat on the S&P, now up almost a 0.5%. So to your point, we are seeing that grind higher at a time when bank earnings have largely been good. Goldman Sachs, perhaps, notwithstanding with their fixed income results. But if all things being equal, there is no banking crisis, is this an all-clear sign for stock buyers, even if people are trying to game out the rate debate and what's going to happen with the Fed on the other side?
So the idea of sticky inflation, that implies some form of nominal GDP. Now, is it a 4% run rate nominal? No. Is it 4.5, 5.2? I don't know. I don't think anybody knows. But you've got to calculate in the money illusion of a better nominal GDP into revenue and earnings reports.
It's hard for me to create any kind of narrative with what's going on right now in markets, because on one hand, you're right. If we have a stickier inflation, that also means stickier revenues just on an absolute nominal basis. And that means that also people still have money to go out and keep spending. And yet, two-year yields are slightly lower on the day. So go figure, right? How do you understand the Fed's function? How do you understand what kind of downturn there will be if it's nowhere in sight and people keep spending? And then if the Fed keeps rates where they are, well, does that change the whole equation again, Tom?
Well, I'll have to see. I mean, somebody just emailed in and they said I got wrong. Fourth theory?
Fourth theory? They said that it was not the case?
It's not. I don't know.
Eighth theory?
You're wrong. It's not fourth theory. We'll keep looking at all the fourth year and tertiary economic statistics as well, and they get quite important here because there is a date out there we haven't talked about enough today. May 3rd approaches. All of a sudden, we're into that point where the data lines up. The data's fresher as they go to that Fed meeting.
Well, perhaps they'll have an insight into what we get on May 8th, which is a senior loan officer survey, which might give a greater sense of how quickly credit conditions are tightening.
With Dow 34,000, that's not what's important. So says Jonathan Ferro. SPX 4196.50, right up against 4,200. Stay with us on radio. On television, this is Bloomberg. Good morning.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The United Nations says fighters in Sudan's capital targeted buildings occupied by diplomats and international humanitarian agency staff. Armed personnel entered the homes of people working for the UN and international non-governmental organizations in downtown areas of the capital. Now, that's according to an internal UN document seen by Bloomberg. The gunmen sexually assaulted women and looted people's belongings, including cars and personal items. Forces loyal to the head of the army and the paramilitary Rapid Support Forces have clashed for the past 4 days, leaving about 180 people dead. The group of 7 nations vowed to support Ukraine for as long as it takes in its fight against Russian forces. G7 diplomats met in Japan again today and condemned Russia's war against Ukraine. The bloc also called for greater engagement with China to stabilize relations with the world's second biggest economy, including a peaceful resolution of Taiwan-related issues. Taiwan will buy as many as 400 land-launched Harpoon missiles intended to repel a potential Chinese invasion. Congress approved the deal back in 2020. Taiwan had previously purchased ship-launched versions of the Harpoon, which is made by Boeing. The contract with Boeing was issued on Taiwan's behalf by the U.S. Naval Air Systems Command. The United Nations making a renewed appeal for international aid for Afghanistan. Afghanistan remains cut off from the global financial system since the Taliban took over in 2021. The UN says $4.6 billion in foreign aid is needed to import food and jumpstart the economy. Without it, per capita income could fall to $306 next year compared to $512 in 2020, making Afghanistan one of the world's poorest countries in the world. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
You're not seeing broad distress yet. You're in the transition period. We had 14 years of low interest rates, and the real impact on valuations, it takes a while to filter through. We're in an evolving market in the States. What was a deposit liquidity crisis is now an evolution of their business model, and really it's going to be a period of tougher financial conditions.
Jim Zelter, a clinic there, must watch for Global Wall Street. Really, really quite good. He is with a small shop, Apollo Asset Management. What did he say? He's got $42 trillion in the kitty?
Well, he's got $50 billion of dry powder ready to go for when there is a knock at the door and possibly an opportunity.
Well, I made a joke you should buy Chelsea, and he wasn't laughing. He's taking notes. Oh, that would be good. We should. Okay,
he didn't want to discuss it, but it had nothing to do with necessarily any potential.
What was the message you got from Jim Zelter?
That it's going to take 3, 6, 12 months to really understand the credit tightening, that there is perhaps this ongoing role of opportunities that a lot of these private firms are looking for at a time when some banks banks are not going to want to have these businesses, whether it's Credit Suisse, whether it's Silicon Valley Bank, whether it's First Republic. Some of these firms that are going to run into trouble might be bespoke opportunities. They might be idiosyncratic, but there are plenty of their people there ready on the other side.
What we're going to do, and I don't want to waste any time here. This is so important. There's a rare appearance. Allison Williams with us with Bloomberg Intelligence, who is truly esteemed across decades of banking analysis. And she joins us today. What I thought was the oddest division, and that the banks are like, okay, revenue's up, surprise. And then there's this one bank challenged. Let me cut to the chase, Allison Williams. Why is Fortress Solomon challenged?
I think it's really the cost side with Goldman. So they did miss on fixed income trading, but they did better on equities and they did better on fees. So I would say net, the investment bank came in line. Granted, the other people had positive surprises, but Goldman is coming off some tougher comparisons.
Do they need to lay off a lot of people?
You know, the head count does look like it came in a bit lower than expected, and I think they are making those cuts. A lot of the cuts we saw relate to Marcus. That also contributed to some noise in the quarter. They took a loss on some of those loans. They had some provision kind of come back into earnings related to that.
The Apollos of the world aren't the only ones looking for opportunities, and I wonder about how much in the numbers that we're seeing is some of the big U.S. banks taking business from Credit Suisse, from other potential firms that might be kind of in a weaker position. How do you parse that out in some of these results?
I think that's a great point, because I think that is exactly why we saw this huge quarter of Bank of America fixed income. Huge in the sense that they had sizable growth. I think it was up almost 30%. And if you think about the businesses that Credit Suisse really excelled in, so securitization, spread trading, all those types of businesses coming in really strong at Bank of America. Granted, they have easier comparisons, but I think that there is definitely some share gains going on there.
Do we have a sense of who the likely winners will be as this whole process evolves of credit tightening and potential distress at specific firms? I mean, is it going to be JP Morgan, Bank of America, and Citigroup? Is that what we've learned over the past couple trading days?
I think in terms of the deposits, we did see Bank of America, Wells Fargo, and JP Morgan all benefiting from that flight to quality. So only JP Morgan showed a net increase over the quarter, but we saw in some of the detail in Bank of America's numbers that those last couple of weeks they are gaining share. And that really, I think, goes to the very longer term story. The U.S. banks have gained share in retail deposits, the big are still getting bigger, and in trading.
Well, so this is the issue that I was grappling with. Back, 15 years ago, people were talking about too big to fail and banks getting too big. And now we're in a situation where regulations, ironically, are allowing the biggest banks to get even bigger and for there to be consolidation among some of the smaller banks. I mean, is that an inaccurate way of portraying it?
Well, I think that's a great point, and I would add to it two things that I think about. One is Credit Suisse. You know, this was a more narrowly focused business, and it was a business that did not succeed. And I think if we look at the last crisis, right, it was sort of the more narrowest businesses like Lehman and Bear that failed, whereas companies like JP Morgan survived. Granted, we did have some government help in a lot of the other businesses, but I think that the retail, the mix really helped out. Secondly, what's coming out of this is really that we need more regulation on some of the smaller banks. Right. And so some of the sizable, some regional banks that are sizable enough that they can have some of the issued debt and have some of the protections that have been put in place for the bigger banks.
Bank of America has an operating income, I'm going to say $32 billion. Some of the regionals I look at have $2, $3, $4 billion. These guys are teensweens compared to these majors. Are they under a pressure in this stress to acquire? I mean, isn't this the time the regionals gross up?
They can. I mean, keep in mind, so Bank of America and JP Morgan can acquire because they're already they already have so many deposits they can only grow organically.
This is it. This is what they've been waiting for, right?
I think we have. I mean, Truist was one of the banks that was created, right, created just for this respect. They wanted to have a bigger tech budget, compete with these bigger banks. And I think, the jury's still out in terms of if that's been successful.
Do you believe they can compete with the big guys? The thing I saw today was Brian Moynihan had checks written going down and Zelle going up like a moonshot. How do they compete against that?
I think it is about having the best cutting edge technology, right? And so just because you spend more doesn't mean you're the best. It has proven to be an advantage, obviously. If you're spending more, you have a little bit more of an edge. But there have been other companies, other upstarts, right? The disruptors are generally not the incumbent. So we have had we've had competitors in other parts of the business, such as Square, become hugely successful. But I think in the bread and butter banking business, which is highly regulated, it's a lot tougher for an upstart to kind of come in there.
And Lisa, if you don't get the technology right, that's called doing an E.F. Hutton. That's what we call that from a few years back.
Okay, duly noted. There is this issue as we look forward to the earnings from Western Alliance and other regionals going forward about whether the business model makes sense and whether it's too soon to tell, right? Because you talked about more regulation and the potential for consolidation there. When will we know what the real fallout is?
It's going to be interesting to see if the regulators come out and proactively put something in place. I think what the couple of things that seem to make sense is, first of all, having some kind of liquidity ratio that is more punitive to uninsured deposits. There's also been talk about raising the insurance deposit limit. I think that is something that has to be coordinated globally, or else you are going to, sort of risk deposits moving one way or the other. But the three big banks have made it a point to say, look, this was something temporary. It's over. I do think, however, that if you have businesses with imbalances, you need to figure out a way to right those imbalances, or you can become vulnerable. And I think that's why you're also seeing Bank of America going through so much detail today to show, look at our deposit base, look at how diversified it is. Here's the story of what happened to us, how we built up these securities portfolios, and now we're running those down.
30 seconds. With the returns on equity they have and the other fancy pants balance sheet ratios you guys use, is it just simple to say that we will see a price-to-book expansion among these banks, that they will recover on a price-to-book basis?
Well, I would say in the near term, and again, just to remind, we don't do buy, sell, hold, but we can sort of talk about things that drive the stocks.
Yeah.
And I do think the returns are impressive, but it is very hard for banks to outperform going into a recession.
Okay.
But the positive thing is, as we come out of it, the fact that we can look at JP Morgan, 23% return on tangible common, probably going to beat their target this year, probably going to beat it next year. That bodes well for structural valuation.
Allison, thank you. Allison Williams, Bloomberg Intelligence here, really with just terrific banking experience. This was a great banking day. I actually learned a lot.
This is actually
what's going on.
Agreed. I do think that as some of this bleeds forward, the banking system will change dramatically in 2023. I think that that's the takeaway, is that you're going to see that greater consolidation, a bigger existential question around regional banks and their role in lending and their role in terms of the community and what they have to do in terms of regulation and just, survival of the fittest. And also just them making the biggest profits.
And that goes away from the Fed ballet and the interest rate guesstimates over to business strategy. And I think that's where Jim Zeltner was with Apollo, is saying a lot of people have to figure out a new business strategy given where rates are right now.
And they're going to be there for that. Of course, at what point do we see a number of companies left behind when it comes to financing, unable to get financing?
What about
in the new rate regime?
Investors left behind. To me, short squeeze is going to be interesting to watch as we try to get to the opening. 4197 on the Standard & Poor's 500 futures. Stay with us on television and radio. It's Bloomberg Surveillance.